The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures trading in the red this morning as investors digest the latest economic data and earnings. ADP private payrolls coming in above expectations ahead of the January jobs report that is to come Friday. Meanwhile, Morgan Stanley is raising the alarm on tariff uncertainty, cutting their forecast for rate cuts from the Fed this year down to just one.
Plus, Alphabet and AMD sinking today. The Google parent company reporting disappointing revenue due to a slowdown in its cloud business. The results also raising some concerns about Alphabet's AI spending plans, which came in well above the street's forecasts. Meanwhile, AMD reporting data center revenue that was weaker than expected. It's a sign that it's still struggling to catch up with AI computing leader NVIDIA.
And Apple facing a potential probe in China. China's antitrust watchdog laying the groundwork for a potential probe into Apple's policies and the fees that it charges app developers, according to Bloomberg. The examination of Apple's practices in China began before President Trump took office, but they're now colliding with a series of tit-for-tat moves between Beijing and the Trump administration, which is threatening to ignite a global trade war. U.S. stock futures are sliding this morning as the tech-heavy Nasdaq is leading those declines on a fractional percentage basis, as it may be. It's down 0.7% as disappointing big tech earnings weigh on the index. Alphabet having a particularly tough morning, dragging other Magnificent Seven names lower after reporting slowing cloud revenue growth and expected CapEx spending that's coming in higher than expectations that we've seen as well. So taking a look at the Magnificent Seven stocks, four of them that we've got pulled up here on the screen, you are seeing them lower. And Alphabet, the worst of the decliners, down by about 7.5% here pre-market. You think through to some of the things that we heard on the call last night from the executive team over at Alphabet, things such as specifically what they were calling out within that CapEx number, $75 billion is what they're targeting here in CapEx in 2025. And in the front end of this year, at least in the first quarter, $16 to $18 billion of that is earmarked in the first quarter, and then the additional expected total investment level, they say, may fluctuate from quarter to quarter, primarily due to timing of deliveries and construction schedules. All these things, though, they're going to be hiring, it sounds like. So that is something similar to what we've heard from some of the other companies that have put forward their own, Palantir being one of them, their own CapEx expectations as they're investing further into their businesses.
Yeah, I think when you take a look at the extent of the drop here this morning, once again, this raises the question that was very much front and center of investors' minds over the last several quarters. But I think the evolution and the headlines that we got of DeepSeek very much putting even more emphasis on AI spending plans. And I think the reaction that we're seeing in the stock this morning very much shows that the street might be rethinking about whether or not all of this AI spending is going to pay off, and ultimately maybe what that means here for the broader market. When we talk about how critical these handful of companies, the Mag 7 companies, have been in propping up the market, keeping the market's momentum going here over the last couple of years, making it more than half of the index's gains over the past 2 years when you take a look at the outperformance there of the S&P. And then when you take a look at the trend that we're seeing so far this earnings season. So right now we have 5 of the Mag 7 results. We're going to get Amazon tomorrow, NVIDIA out later on this month. But very much as expected, we are seeing profit growth slowing just a bit. So this is raising some alarm bells, I think, on the street, just in terms of maybe the threat that this eventually poses to valuations, given where so many of these stocks are trading right now. You can make the argument that Alphabet very much trading at a discount to some of the other names within the space, but more broadly speaking, the group's still trading at about a 40% premium there to the broader S&P. So again, I think we're seeing maybe a bit of a recalculation just in terms of what this could potentially look like or should look like going forward as earnings growth is continued or expected to continue to slow.
Yeah. For more on what Wall Street is saying about those Alphabet results, let's bring in Yahoo Finance tech editor Dan Howley, who's been looking across the street, across the Wall Street landscape, at least, to see what some of the reaction has been. Dan, what have we found thus far?
Yeah, not good. Not good is basically the way I would put that. Let's take a look first at AMD. They're the company coming out, obviously, with their earnings. Decent beat on the top and bottom line. The Q1 outlook was a little bit better than anticipated, but the big deal here is that they're saying that first half revenue for data center will be about flat. So similar to what they saw in the second half of 2024. Everything else is going to be in the second half of 2025. That's when they're going to see their next AI chip come out. So that's when they'll start to see that reacceleration. And so that's why we're seeing this reaction so far this morning from some analysts who have dropped their price targets on the stock. We have Bernstein dropped from 150 to 125, Piper Sandler from 180 to 140, Mizuho dropped from 160 to 140, Stifel, Deutsche Bank, Raymond James, all dropping their respective price targets on AMD at this point in time. And then let's just take a look then at what's going on with Alphabet, which is struggling significantly more this morning than AMD is. We look at basically the results, not terrible overall, but the main problem here is the missing cloud. They came in with revenue at $11.9 billion on expectations of $12.1 billion. It's also a deceleration as far as overall cloud revenue quarter over quarter. So that's a metric that you continue to watch when you're looking at cloud revenue. Microsoft, you would watch the same thing. And so anytime there's any kind of deceleration, you're going to see that kind of reaction from the stock price. But then also just a mega burst of CapEx spending here on AI. And so they say that they're going to spend $75 billion building out CapEx in 2025. That's up from $57.9 billion. So an absolute huge amount of money being poured into this effort. And one of the upsides here for Google, at least, is that they were saying there's still capacity constraints. So demand is outweighing supply when it comes to their AI offerings, their cloud offerings. Similar situation at Microsoft. And so there's good news there. They just have to now spend even more to ensure that they can meet that capacity. And we'll just have to see when that starts to kind of even out. Expectations are for later this year for both Google and Microsoft. And I mentioned Microsoft because obviously one of Google's chief competitors in this space.
Yeah, certainly we are seeing the spending plans spook the street just a bit. Dan, so we have the earnings story that's clearly driving a lot of the action this morning, but we're also getting some headlines out on Apple. You're looking at Apple decline just over 2% here in pre-market trading. There's reports out that China's reportedly weighing a probe here into its App Store business. What are the details there, the risk potentially that this poses here to the tech giant?
Yeah, I mean, obviously, any time that the state's getting involved with these companies, it's scary. We had them announce that they're looking at an antitrust probe into Google the other day. Now, Apple kind of getting pulled into the mix more so. This has to do with the App Store and App Store policies, similar to kind of what has been happening everywhere else in the world with regards to Apple and the App Store, the payment options, the amount that's taken from developers when it comes to payments. I was reading some analyst notes on this, basically saying that this isn't that big of a deal as far as overall revenue goes, about $5 billion of revenue. I believe our friend at Wedbush, Dan Ives, had pointed out in one of his notes this morning. So not a massive issue overall, but I think this is more of a broader problem for big tech, that they're now a bargaining chip when it comes to this tit-for-tat trade war that we're starting to see heat up really between the U.S. and China. And, coming out with Google right away, coming out with Apple the next day or a day later, it's starting to, or they're attempting to send signals here that big tech isn't necessarily safe in some of its most important markets. And, I want to point out for Google, China isn't that big of a deal. When it comes to Apple, it's a much larger deal. It's one of their largest markets overall when it comes to revenue, especially when it comes to iPhone sales. So, any wrench that gets thrown into those works is a big deal for them.
All right, Dan, thanks so much for breaking that down. Well, the other big news story this morning, the escalating trade tensions between the U.S. and China. Now, China is weighing a potential antitrust probe into Apple's App Store practices. That's according to the latest out from Bloomberg. This coming after the country retaliated against U.S. tariffs with levies of its own and a probe into Google. Joining us now, I want to bring in Jason Furman. He's a professor at the Harvard Kennedy School of Government, former chairman of the Council of Economic Advisors under President Obama. Jason, it's great to have you back here on the program. So we're starting to see, it looks like at least, this emergence of a tit-for-tat trade war, trade dispute here between the U.S. and China, at least. And then when you factor in the back and forth between the U.S. and Mexico and U.S. and Canada earlier this week, I'm curious your assessment of how this has all played out so far, and maybe the risk that this trade tensions or strategy still poses to the economy.
Yeah, so it's hard to disagree with the Wall Street Journal editorial page, who called the Canada and Mexico trade war the dumbest trade war in American history. I'm glad to see the president pulled back from that. He got nothing from Canada and Mexico. He just seemed to have changed his mind. But that's fine. We're in a better place now. China, people don't appreciate the scale of what the United States has done, for better or worse. President Trump, in his first 2 weeks, put tariffs on China that were twice as large as what he did in his entire first term. Entire first term, he waited 18 months. He started with $40 billion. Here he's starting with $500 billion of imports that are being tariffed. So this is a significant escalation vis-a-vis China, even if it's not coming with the same fireworks that it did in his first term.
How much more difficult do you think this will make it, Jason, for U.S. companies to operate in China?
I mean, there's already been an increased process of delinkage between the two. This certainly will further that. In the past, when we've seen negotiations over tariffs with China, they've tended to be about how not to increase the tariffs further, as opposed to taking back any of the existing ones. That's broadly what I expect to see here. Moreover, you look at China's retaliation. You were talking about it right before we started talking. The investigations they're launching into American companies. That's not rule of law. That's not neutral treatment. And that makes companies think twice, 3 times, 4 times about doing business in a country.
Is it bad overall for business investment?
I think broadly speaking, yes, it is absolutely. Uncertainty isn't good. I mean, the first thing businesses worry about is uncertainty. There's just much more uncertainty now vis-a-vis whether the Canada and Mexico ones will come back, whether they'll happen with the European Union, what will happen with Taiwan, other countries around the world. And yeah, I think that's going to be taking a bite out of business investment going forward.
To what extent do you think that tariffs and tariff talks or tariff policy that gets enacted also revises things like the Fed and the FOMC's decisions to cut rates this year and the number of cuts that have even been kicked around coming into the start of 2025, where now you have some major banks kind of adjusting their own Fed rate cut forecasts amid some of how the economy might ingest what the impacts of tariffs are?
Yeah, I mean, the main thing that's affecting the Fed is that the employment output side of the mandate is doing perfectly fine, even with relatively high short-term rates. The inflation side of the mandate is still a bit off on the side of extra inflation. And so that combination, I think, would have caused the Fed to be very reluctant to cut rates in any scenario. But there's no doubt that the anticipation of future tariffs is an extra reason for the Fed to raise the bar on what it would take to resume rate cuts. The China tariffs will probably add about 0.1% to U.S. inflation. It'll be a one-time price level thing, but other tariffs would be more. And at a time when inflation is already elevated, I don't think you can afford to say, don't worry, this is just a one-time level effect. I'm going to look through it. The Fed would respond. So yeah, this is a thumb on the scale of higher interest rates right now.
Jason, is there a point where some of these proposed tariffs, or if it escalates to a certain extent, that it's going to revive some of the rate hike talk?
I think we are at roughly 2.5% inflation. If we get to 2.8, 2.9, 3.0, rate hikes are back on the table. One of the surest ways to get there would be something like a 10% across the board tariff on the entire world, bringing back the 25% on Canada and Mexico, any of those. But, we're also just, inflation's unpredictable. It bounces around. So my 2.5 estimate is off a little bit. Absolutely, I think rate hikes are on the table for this year, but with still a relatively high bar to move in either direction, probably a higher bar to move in the rate hike direction, but not an insurmountable bar.
As you think about the Fed's dual policy mandate, of course, we've talked a lot about the inflation side, but also you mentioned the employment side a moment ago here. And we do know that there are some new efforts within the administration to really prioritize what they're calling this Department of Government Efficiency, DOGE, and just that focal point around efficiency, even offering workers the ability to take take severance essentially for months, and how that might show up in the economy. How are you kind of running the calculus around that, if there will be a needle-moving impact one way or the other?
I don't think Doge is going to move any macroeconomic needles. I believe that it was 20,000 federal employees that have taken that offer so far. Maybe some more will. Regardless, they're actually going to be on the payroll through the end of September. They're going to be employed, so you won't even see that in the data. And when I look at the daily Treasury statement, which shows every single day how much the Treasury is spending, you do see things like USAID basically going down to zero. But you look at the aggregate number, the moves have been imperceptible since President Trump has come into office. To really change the fiscal direction we're on, we'll take laws from Congress, and I think it's an open question that whether those laws are likely to increase the deficit, which I think is actually the most likely, or decrease the deficit.
Jason, what are the right tools that should be enacted by the administration? If tariffs isn't the right way to go, we also have the tax cuts. Obviously, they're hoping that some of the revenue from tariffs is going to offset some of the lost revenue from tax cuts. But when you take a look at some of the slashing that's being done inside the government, what do you think the better approach is at this point?
It's to take a deep breath. I know they want to move quickly and they want to move ambitiously, and there's a part of me that applauds that. Take a deep breath, spend 2 months, come out with a budget and say, look, here are the different areas where the government's spending too much, where we can get something just as good for less money, or where we're getting something that's just not worth it, so we can cut it out. Have that go through the process in Congress and put a lot of pressure on Congress to do something. I think that has always historically worked better in the United States when you're putting everything on the table. So you're willing to raise taxes and cut spending, make it a bargain, bring all sides together. This is very, very far from the paradigm we're in now, but it's the one that Ronald Reagan used, that the first President Bush used, that you've seen conservative governments in the UK use. Put everything, including revenue, on the table. We have a big budget issue. Need to do a lot to deal with it.
All right, Jason Furman, always great to get your insight. We really appreciate you taking the time this morning.
Thank you.
As we head to break, let's get a check on some of the earnings movers that we're seeing this morning. Alphabet, AMD, Disney, and Snap all on the move. Let's start with the two at the top of your screen. You're looking at Google and AMD under a bit of pressure, putting into question that momentum that we had seen as of late in the AI trade. You've got Google very much the focus there. Some questions about AI spending plans, whether or not too much is being spent on AI, and then AMD questions just about how well they are able to compete with the leader in the space, NVIDIA. You got Snap right around the flat line. And Disney, though, moving to the upside here following its strong results. You're looking at gains of just about 1.5%. We'll be right back.
Let's take a look at some of this morning's trending tickers here, and you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We got to take a look at shares of Disney, DIS, moving higher after the House of Mouse beat expectations with profit in streaming offsetting some of the losses in the parks business. Yahoo Finance executive editor Brian Sozzi sat down with Disney CFO Hugh Johnston this morning. Take a listen.
We're doing a nice job of eliminating unnecessary costs and at the same time investing back in the business in all of the right ways. And what you're seeing out of it is obviously terrific content coming out of the studios, whether it's Moana 2 or Mufasa or earlier Inside Out 2 and Deadpool. ESPN obviously had a terrific quarter with the college football playoffs as well as the SEC. And Experiences had a better than expected quarter in many ways. Despite the fact that we had hurricanes, the business was flat in line with the guide, and that was up about 6% from an operating income basis. So overall, the company's really firing on all cylinders right now, and I think we're fueling it well to continue to see that performance.
You know, looking at the operating income performance at the linear TV network stations, I mean, there was pressure there. Of course, we know that you see that ongoing shift to streaming, but is there opportunity to go deeper on cost savings to get it to the point where, yeah, revenue might be declining, but there might be a couple quarters where we can get profits rising because of new cuts?
Well, I'll tell you, the way we think about it is in a more integrated way. So to me, the linear networks and streaming are in many ways two sides of a coin, because a lot of the content that we produce actually winds up in both locations. So in many ways, we've kind of perfectly hedged the business. If consumers choose to stay in linear, we're perfectly happy with that. On the other hand, because of the nature of streaming with the high incremental margins for the additional subscriber, almost software-like in many ways, if consumers choose to move over, we're good with that. So a lot of our focus on cost is how do we get the right aggregate outcome rather than focusing on one or the other side of the coin.
And you're still, I remember when we talked 3 months ago, you told me that you still want to be in the business of old school linear TV. Is that still your assessment?
Yeah, for sure it is, because of exactly what I was talking about. You know, so much of what we do is integrated in so many ways. I understand other companies have made different decisions based on where they sit in terms of streaming, but given we have almost 180 million subscribers, we've really achieved a level where the streaming business is a terrific business unto itself. And because of the integration with linear, I think we can make it better than what other people can, because we can produce content that cuts across both distribution channels.
Hugh, I'm going to get this question at some point today, so I'll just put it to you. So Netflix added 19 million subscribers in their most recent quarter. Now, Disney, more pressure on Disney Plus. Square that for us. You know, what are some of the dynamics you are seeing in Disney Plus?
Yeah, so you know, subs are going to move up and down a bit from quarter to quarter. We had indicated that we expected them to be down slightly, and in fact, if anything, it came in slightly ahead of our expectations. Netflix obviously had a big quarter in terms of content, both with some of the sports activities and some distribution deals they had done outside the U.S. But from our perspective, we're managing the business in a way where we're trying to grow subs and we're trying to improve margins at the same time. And we're very much on track. In fact, if anything, slightly ahead in terms of achieving both of those goals.
You think subs will be up this year? And if so, what are some of the drivers?
Yeah, we do expect it to. Combination of more and better content as we get toward the latter part of the year. The ESPN Plus tile flagship will be an option that will be a part of Disney Plus. In addition to that, paid sharing is certainly going to be a driver. So you put all of those pieces together, and we feel like we've got the right formula to grow subs, and at the same time hit the $1 billion plus financial goal we set out for ourselves.
Do you have any opportunities to push through more price hikes?
In the short term, we don't have any plans to do that, but my expectation is that the value that's delivered in streaming, even compared to cable right now, is so strong, both in terms of price as well as the consumer experience. You get recommendations, you can choose what you want, you can choose where you want to watch it, that I think over time you're going to see pricing continue to rise in the coming years on streaming.
All right, looking at Disney shares up just about 1% here in pre-market trading. Coming up next, we've got the opening bell. We'll be right back.
Just seconds away from the opening bell, you're taking a live look at the NYSE, where Compass rings today's opening bell. And you've got VEEA ringing the opening bell at the Nasdaq. That's the ticker symbol and the company logo. All right, taking a look at today's bell ringers, we're also taking a brief look at the opening cross with the major averages here. As of right now, as things are opening up, you're seeing exactly where things are calibrating towards S&P 500. That, similar to what we had seen in the futures, opening lower by about 0.2%. Dow Jones Industrial Average, that starts off the day flat, just barely to the downside. We'll keep close tabs on that as we move on throughout the rest of today's session. As you can see, we're getting some hyper waffling even out the gate for the Dow Jones Industrial Average on this Wednesday, oscillating between gains and losses. The Nasdaq Composite, though, that is squarely in the red. That's down by about 0.6%. Speaking of some of the sector activity that we are taking a look at here and zeroing in just a little bit more on technology for a hot second. Technology, XLK, you're seeing that up by about 0.1%. But on both sides of the extremes here, pulling up the caboose, you've got communication services to start off the day down by about 1.3%. You've also got on the other side of that range, real estate. That is up by about 1% to start off today's activity. So we're relatively split here. It looks like more Actually, you know what? We've got not far more, but we've got more gainers than laggards. Anyway, taking a look at the Nasdaq 100 here and some of those mega cap tech stocks as well here. We've been breaking down Alphabet's earnings here this morning. You're taking a look at the opening bell of declines of about 8%. That's exactly what we were taking a look at coming into the start of today's trading activity. $75 billion is what they're talking about in CapEx as they continue to ramp some of that AI spending. Sounds like they're going to increase the number of headcount at the company as well. Hey, take a brief gander at NVIDIA as well here at the gates this morning. You're seeing that up by about 3% here. We'll put this on perhaps a longer chart for you just so you can see exactly how we've been moving and navigating these markets over the past. This is a 10-day look at things, and I'll give you a year-to-date just so you have what has been essentially all of 2025 encompassed. We're still down by about 9% for NVIDIA to this juncture. For much more of a deeper dive on today's opening cross and some early trade, let's get on over to Yahoo Finance's Jared Blickery. Hey, Jared.
Thank you, Brad. Let's take a look at the Wi-Fi Interactive, where we see the Dow is just trying to turn green. You can see it just flashing there, barely up a basis point. Russell 2000, though, is leading the show early on, and that was the case before the market opened. And we got to check in on the bond market before we get to some heat map action. In particular, the 10-year T-note yield is touching a 7-week low, and yesterday it had a little bit of a reversal. It started up, but then it drifted down all day, and so just a reminder, down is the direction we generally want for risk markets, though it's a bit simplified there. And if you squint, you can see a kind of a head and shoulders top that has formed over the last 2 months. So you might expect a downward target somewhere in here, right by the unchanged line, right around what, 4.25%. We have to see if that comes to pass. Also want to check in on the US dollar, which is looking a little bit weaker today. By the way, it is down 3 days straight, and that's important because it had that big spike up on Monday, and that was in reference to all those tariffs that have been surprisingly or not surprisingly added over the weekend. Anyway, the net direction of the US dollar is down. That is good for risk assets, and that's what we want to see. And then just getting back to the sector action that Brad was looking at earlier, we have utilities now leading. It looks like interest rate sensitive sectors are leading the way here. Real estate also in the top two, but what is kind of pulling up the caboose here is communication services. That's consumer discretionary, XLY. Tech was in this group earlier, but not right now. And those happen to be the mega cap sectors. And XLC, by the way, has been up 12 days straight. Both Alphabet and Meta are in that camp. And you'll see Meta now. Meta was negative just a few seconds ago. It is positive now. So it looks like Meta, which was in danger of snapping its 12-day streak, that may be going to 13 today. So we'll have to see. Also want to check out NVIDIA. Brad was just looking at a chart. I want to show you candlesticks because we are right up against right now the 200-day moving average. It's somewhere right in there. So 123 is kind of my line in the sand. If we close above, that is very good news for the bulls because it means this breakdown here was just a false breakdown below that critical support line. If we instead rally, or if we reverse down off of 123, it means the opposite, and that means that the bears, the shorts, are in control. Also want to direct everybody's attention to Palantir, which has just had an incredible run. It's coming off its best day in a year, and 1 year ago, it was reacting to earnings very much the same way. Ian McMillan noting on X in an X post that it has several unfilled gaps going back several years here to its IPO. None of them filled, to put a fine point on that. By the way, gold, $2,900 an ounce, and yet one more record, Brad.
All right, Jared, thanks so much. A lot to keep tabs on in today's trading activity. Appreciate the breakdown or the setup. Well, shares of Alphabet sinking at the open today on the back of some disappointing earnings results and big spending plans. Let's send it on over to Catalyst co-host Madison Mills for a look at CapEx plans among the tech heavyweights. Maddie, what are you seeing?
The big question here, does Alphabet have a spending problem? When you take a look at their CapEx, an anticipated $75 billion for 2025, sounds like a lot. It's above Wall Street's estimates. When you compare it to their competitors, it doesn't look that bad here. Take a look at Alphabet behind me. Their anticipated CapEx for 2025 coming in at $75 billion. Right in between two of their big competitors here, Meta anticipating $65 billion in CapEx for 2025, and Microsoft anticipating $80 billion Amazon coming in right in line with Alphabet, around $75 billion here. And I want to flip the board over to take a look at the cash holdings of these companies as well, because this makes Alphabet look like the king of budgeting compared to their competitors here. Alphabet has $99 billion in cash on hand, almost over double what we have for Microsoft at $42 billion in cash, and Meta coming in just under $50 billion in cash holdings here. In terms of the percentage of their revenue spent over the last decade, Alphabet's been spending about 13% of their revenue. Meantime, Meta and Microsoft spending over 30% of their annual revenue on AI over the last couple of years here. So why is Alphabet being dinged so much for their spending? Well, my sources this morning telling me that this is specifically about the storytelling on the earnings call here. The Meta CEO Mark Zuckerberg was able to convince Wall Street that the spending was justified and that they'll continue to be efficient in that spending. Meantime, Google not really offering forward guidance or giving the street that story about the justification behind this capex here. Also want to end by mentioning that Alphabet is third in cloud computing, so the pressure is certainly on for them to find a way to win in other areas moving forward, AI, of course, being one of them.
All right, Maddie, thanks so much. It's time now for today's strategy session. The bull market, so far, it's intact, but our big tech earnings changing the equation. Let's break it all down. Yahoo Finance's Josh Schaefer joining us now. Josh, when you take a look at the broader averages, we're not seeing too much selling here, so it's important to put it in context. Do you think at all maybe some of the fear that we're seeing creep into the market in regards to some of these AI leaders is changing that bull narrative at all?
I'm going to argue no, right? Because Maddie was just talking about sort of the issue with Alphabet, or people's issue with Alphabet stock this morning, right? We're talking about Google here. The issue is they're still spending too much on AI, and last week we were worried that they were gonna stop spending. So which one is it? Which one are we actually worried about here? And I think Brad made a good point at the open. Look at Nvidia stock today; it's up over 3%. Because who buys Nvidia chips? These companies, right? So if these companies are going to continue to spend, continue to boost CapEx, then you could certainly make an argument that sort of the tech AI narrative remains intact there. Now, the flip side of that, Alphabet's revenue disappointed, right? And so pushing that over the next couple months, next couple quarters, if you do get the big tech earnings slowdown that people have feared and we have talked about a lot on this program, then sure, yes, that is obviously a headwind for this market. But I think right now, sort of slicing why the Nasdaq is only down about 0.5% when you have one of the largest companies in the world down 8%, earnings generally have been good, right? Alphabet has some specific issues with their own company as far as metrics go, and people being upset and individual investors being upset about how they're explaining that story. I don't think you're leaving this big tech earnings season completely concerned about the AI narrative, and I also think I would point to earnings from other sectors. How about financials? That was a couple weeks ago now. Those were good earnings though, right? And those are some of the companies that, if we're going to talk about CapEx spenders, CapEx takers, the 493 of the S&P 500 are said to be beneficiaries of these companies continuing to spend, right? So if you think about it from a broad perspective, I think the Nasdaq not being down 1% today when one of the largest companies in the world is tanking on earnings might be perhaps something positive as far as market trends go.
Is there a clear consensus among analysts emerging to say, or to clearly guide to when we should start to see some of these major investments actually pay off and translate through to more than just shareholder value, but also realized margins, realized revenue?
Yeah, I mean, it feels like, Brad, from people I talked to, and I'm sure you guys talked to as well, probably the back half of this year, we're supposed to start seeing some of that. And I also think, what are we seeing in this AI agent story, right? So these companies that are using technology from, say, a Microsoft and using their AI cloud to perhaps
shouting the agents are coming.
Right.
Yeah.
2025 is the year of the AI agent, right?
Yeah.
But what do we hear from those companies that are actually using the agents, and are they finding them useful? So then will they come back to the hyperscalers to continue to resubscribe, pay more money for those the AI servers that they can then operate the AI agents with, right? I think you're going to hear more about sort of the trickle down effect of AI, not necessarily maybe specifically for the big tech companies, but am I confident that they will continue to get business from the rest of the market is what we're looking to perhaps learn as the year goes on.
Josh, when you take a look at the econ data, and I bring this up ahead of the jobs data that we're going to get later on this week, it's been relatively strong, right? There's a lot to like in these reports. You highlighted a chart chart in your piece that's up on Yahoo Finance right now, talking about some of the strength that we're seeing in manufacturing, maybe ultimately how this will factor in and play in to the bull market narrative that we have seen. What should investors be looking for in that jobs report on Friday that's going to, I guess, for obviously it would be strong numbers, but beyond that, what that's going to tell us a little bit more just about this bull market staying intact?
Yeah, so first of all, shout out to Tom Lee from Fundstrat. That's our chart, Yahoo Finance chart book, still up on the website. Go check it out. But Shauna, spinning it forward to the jobs market, have to do the plug, of course. But spinning it forward to the labor market, I mean, I think you still want to see continued strength, right? That pickup in manufacturing data is important. You look at ADP's numbers this morning, the only sector that lost jobs was manufacturing, right? The manufacturing recession has been a story for a long time. Do you start to see a rebound there, and does that help the labor market? Because we've been in a labor market dynamic where there's not a lot of hiring across sectors. There's very small sectors that are sort of driving this hiring. So do you start to see a little bit of broad-based growth that makes you feel more confident in the growth? But to your point, overall in the data, and sort of what I wrote on the website this morning of plenty of bull signals still flashing, you're still seeing relatively strong economic data, and that's where you want to be at this point. I don't think you want to be in a market where we're talking about rate cuts because economic data is weakening. So
Be careful what you wish for.
we want to have jobs. That's always my take on the jobs report, guys.
Totes.
It's good. It's good.
Yes.
As Jay Powell said, it's great to have a job right now.
Certainly is. All right, Josh, thanks so much. Giving us the insight we all need and more. All right, coming up, how proposed tariffs could impact the cost of your burrito, potentially. Chipotle CFO Adam Reimer, he joins us next following the company's earnings results. We'll have that conversation for you when we come back. Chipotle beating fourth quarter estimates, but shares falling after forecasting disappointing same-store sales growth for 2025. The company warning that they could potentially see roughly 60 basis point impact on raw material costs this year if proposed tariffs on Canada and Mexico do take effect. Joining us now, we want to bring in Adam Reimer. He's Chipotle's CFO. We're also joined by Yahoo Finance executive editor Brian Sozzi. Great to have you both. Adam, let's talk about the quarter and maybe the share reaction that we're seeing this morning. A lot of that focused on the guidance that you gave, but zeroing in on some of the tariff commentary, because tariff threats by the Trump administration clearly adding some uncertainty to that macro picture. How are you navigating that?
Yeah, so at this point, we're keeping a close eye on all of the different changes between, the proposed tariffs on Mexico, on Canada, as well as China. And we gave some pretty good commentary in the prepared comments for the script, which we had about 2.5% of our sales or so come from these areas. And so these proposed tariffs, like you said, would constitute about a 60 basis point impact on our margins. So we're keeping a close eye on how this would go. And we're also, not going to necessarily react quickly with price. We're going to be very, very patient when it comes to this to get an idea if these are going to be permanent or if they're not going to be enacted at all. And so we're going to sit tight. And luckily, because we operate our own restaurants, we have a strong balance sheet. We have the ability to do that.
Adam, take us inside the past, let's say, 4 days of being the CFO of Chipotle. One day, we had tariffs across the board. Then we had no tariffs. Then we had tariffs somewhat going through. Like, what have you been doing? Like, take us inside some of the operating procedures you've been putting in place. Have you had to have emergency calls? I imagine it's got to be pretty chaotic right now.
Yeah, there are definitely a lot of ups and downs, especially preparing for earnings. And luckily, we have an unbelievable finance team and a supply chain team that we had all the scenarios mapped out. And so as we were getting closer and closer to the call and we were seeing, okay, the tariffs seem like they're coming live. Wait, no, they might be falling off, or it's just going to be China, not Canada and Mexico. We just pivoted up until the last second. And again, I give a big shout out to our teams for allowing us to make that a very seamless process.
Is it impossible to plan in this backdrop?
I wouldn't say it's impossible to plan because we're going to continue to do what it is that we do. Operate great restaurants, really focus on the things that we've got ahead of us, an amazing marketing plan for the year, exciting LTOs that are coming, executing on throughput. I mean, those things are what's front of mind. And we'll react, as the tariffs come in, we're able to absorb these costs for a very long period of time before we decide, okay, do we need to make a change to our business? But that's really where our focus is operating great restaurants each and every day.
Adam, looking through to how that operation played out and some of the figures that came through these highlights as well during the quarter. Average check growth, 1.4%. That was higher than the street's expectation. The traffic growth was just a smidge lower than the street's expectation. I wonder, as you're kind of balancing and looking through that check growth number, is this a matter of pricing or is this a matter of appetite that you're seeing from consumers?
No, I mean, we're really proud of the results that we put up in the fourth quarter. As you said, we had over 4% transaction growth. And when you look at the full year, it was actually over 5% transaction growth. And that's really tough to come by in the industry right now. I mean, everyone's fighting over every transaction. But there was a little bit of weakness at the end of the quarter, which we called out due to really factors outside of our control. And that was the calendar shift around the holidays. When Christmas moves from a Monday to a Wednesday, as well as New Year's, there was an outsized holiday impact. And so that's really what brought a little bit of pressure on our transactions from what Wall Street was expecting. But again, we believe that we are executing really well in our restaurants, and we're really proud of these results.
Adam, going back to what you just said a moment ago, when it comes to pricing and your strategy then going forward, you said you're going to absorb it until you can't. At what point can you not absorb those higher costs?
Yeah, I mean, the way that we look at pricing is simply to offset permanent hits to the business. And so we don't want to grow our margins by taking price increases. We simply want to offset the impact of inflation. And so given how fluid the situation is with tariffs, we will give it a very long time to determine whether or not this is going to be a permanent hit to the business. And if so, then we'll look at, okay, can we offset this additional expense through efficiencies within our restaurant or some other means? And then really it comes to the last resort is pricing. We're very careful with when we take a price increase because we really want to maintain that value proposition that we have amongst our peers and in the industry.
It seems like across the industry, there's more of a focus on what is being offered to the consumer, the menu as well. Do you see the need to trim any menu, decrease limited time offerings even that you've been so well known for Chipotle, putting some of those LTOs into the market?
I really don't think so. One of the beauties of Chipotle is we actually have an original menu. Jack was able to find it about a year ago from July of 1993. And what's amazing about looking at this menu is our menu has not changed very much since then. We've added a couple of limited time offers on a yearly basis and a couple other items like queso and brown rice. And so that's the beauty of Chipotle is the simplicity of our menu so that our teams can offer or can execute every day when it comes to great culinary, prep in the morning, different things like that. And so I don't think we're looking to trim anything. If anything, we're going to continue to lean in on these limited time offers a couple of times a year.
Adam, before I let you go, just going back to the tariff discussion, do you need avocados from Mexico, if at all? And then secondary, bigger picture, what type of changes do you think tariffs will have to the broader restaurant industry supply chain?
Yeah, so avocados from Mexico is really interesting. So if you go back several years ago, probably 90% or so of our avocados came from Mexico. It's closer to 50% today because we've diversified to different countries of origin for obvious reasons, just making sure that we have a really good supply and that we're not completely dependent on one region. And so through those efforts, we'll continue to make sure that we're diversified, but it's not something that we could switch very quickly, but we've done that over time and we'll continue to do that over time.
Adam, great to have you here with us today. I got to continue to keep asking how I get them to add more onto my burrito without kind of doubling the meat.
You just give them more, Brad. Just give them more money.
That's
They'll
what I
double
do.
anything you want, Chipotle.
Yeah, well, I've seen your orders before. Adam,
Yeah, Brian knows.
I do, actually.
Adam, thanks so much for taking the time. Brian, appreciate it.
Definitely. Thanks, guys.
Certainly. All your markets action straight ahead. Stay tuned. You're watching Morning Brief. Let's take a look at some of this morning's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. We've got Yahoo Finance's trending tickers page that it'll take you to. Let's focus in on shares of Novo Nordisk. They are rising after the maker of Ozempic and Wegovy said it expects sales to surge again this year as the Danish drug maker builds supply for its blockbuster medications. Our own Anjali Khemlani sat down with the CEO of the company to discuss.
It has been a tremendous run over quite a period now, and we're really pleased with the 26% growth we saw in 24. When we guide a bit lower for the coming year, it's really because that we grow on a larger base. We actually see the same continued absolute growth as we look into 2025. We're ramping up capacity significantly. Our guidance includes a significant step up in supply. We're already the absolute volume leader in the GLP-1 category, having approximately twice the volume of competition going to the market. And we keep scaling on top of that. And we see a continued large demand in the market. So it looks like a lower relative growth, but it's actually the same absolute growth that we see coming in the coming year.
Yeah, and part of that also, I know you're looking at growing the production and dealing with that FDA shortage as well with the closing of the Catalent deal. So now you have 3 more sites that you're going to stand up, plus the building out that you're already doing of manufacturing. I want to talk about that, though. When it comes to managing expectations and competition right now, how are you planning to stay competitive with your competitor, Eli Lilly, already out of the FDA shortage and ramping up and really proving week over week, we look at those prescriptions, taking a little bit more market share?
Well, I think it's a combination of different factors. If you take capacity first, we are actually ramping, I think, to the same tune as what competition is doing. We grow from a larger base, so it's a smaller relative growth. When we look at 25, we believe that we'll be, if you look at our guidance, that includes at least a 30% growth in supplies of GLP-1. And with doubled, say, installed volume, that actually compares nicely to what Lilly has guided. So I think it's a similar growth we'll have into the market. Then in terms of competitiveness in the market, we are still superior when it comes to cardiovascular protection. We need to go out and give that benefit to patients. In the beginning of the year, there are some formulary changes that led to us having a bit slow start to the year, but I'm quite confident as we move through that and we have more supplies coming and we can fully articulate the value of our medicines, that we'll see a quite attractive share development in the US market. And also outside of the US, we see significant growth. We grew more than 100% last year, and we're also looking at a very attractive growth for this year.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, 30 minutes into the U.S. trading day. Let's get into three catalysts that we're watching this hour.
First up, AMD falling on missed data center revenue and NVIDIA gaining on anticipated capex from hyperscalers. We'll discuss what's next for the AI trade.
Plus, we hone in on autos as talks between Nissan and Honda fall through, failing to create the world's third largest car maker.
And a look at the streaming space as Disney tops estimates with gains for Moana 2. Shares of AMD plunging today after reporting earnings results that disappointed investors. Data center revenue coming in weaker than expected, but not all bad news, as NVIDIA gaining off the back of increased AI spend announced by Alphabet. Joining us now on what's next for the AI trade, we've got Ruben Royce, Stifel's Applied Technology Analyst. Ruben, great to have you on. Help me square this here. We've got slowing revenue, data center revenue growth from AMD, and then we've got NVIDIA recovering today after weeks of pressure. What's going on here when it comes to the AI trade?
Well, thanks for having me, and good morning. I think the AI trade is going to be, from here, maybe a little bit volatile, maybe a little bit lumpy. What we're seeing with AMD, I think, is company specific, and I think it's near term. And we can talk about the reasons for our view on AMD in a second. But I think in aggregate, following last week's shock in the AI trade with all of the DeepSeek news, I think one of the themes that's coming out of earnings season so far is that hyperscaler CapEx in the United States is going up. Meta talked about $60 to $65 billion. Microsoft has been talking about $80 billion. And last night, as you mentioned, Google now talking about $75 billion in CapEx. I think consensus estimates were looking for more in the low $60 billion range. So hyperscaler spending on AI infrastructure is continuing to move up and to the right, and we think there will be a number of beneficiaries as that long-tailed investment cycle continues, and certainly AMD is one of those beneficiaries in our view. NVIDIA, which we like a lot as well, it remains sort of our top way to play AI infrastructure compute. Is very well positioned this year as they are on the verge of ramping their Blackwell platform. So a lot of moving parts, but we can dig into it further.
I guess, Ruben, then just given your stance on what you said just a moment ago on AMD, then what is it that's handicapping that upside, at least in the short term?
Yeah, so a few things. As you mentioned, data center revenues came in a little bit light relative to consensus expectations for Q4. That was a little bit surprising. The company did beat by a very modest amount, and that beat, wasn't, it was driven by client. And, that's not what investors want to see. Want to see continued momentum with AI, again, given all of the data points around infrastructure spending moving up and to the right. So that's number one. Number two, and probably more importantly, is that the company said that their data center segment revenue would look very similar in the first half of this year to the back half of 2024. And that implies sort of a flat MI300 or AI GPU compute revenue run rate, if you will, for the first half of 2025. Again, where's the acceleration if all of the hyperscale CapEx is ramping up to the right? And so, for AMD, like I said, I think it's company specific for now. AMD has a platform that went from essentially zero revenues in 2023 to a little over $5 billion in 2024. I think that's a success story in and of itself. But they do have follow-on technology coming. They've got something called MI325, 325X starting to launch now. And then probably more importantly, on the call last night, management talked about pulling in their next generation infrastructure technology system based on MI350X to the middle of this year. Previously, the company had said back half of or second half of 2025. And so, with those transitions coming, there's probably a little bit of pause with some existing customers, some new customers that are waiting for the new technology. And the company has said that they believe that the second half ramp is going to be quite strong. In fact, AMD management continues to think that they'll have tens of billions of dollars of AI-related GPU revenue over the next several years. So, we've seen a lot of engagements with the leading hyperscalers. We don't think this is a competitive issue. We think it's a timing issue. And we do think that, given where the stock's trading, especially with a little bit of a sell-off today, as you mentioned, downside risk from here seems limited to us. Our numbers came down a bit, but the stock looks pretty cheap.
Since you mentioned the other hyperscalers, I'm curious about the impact of DeepSeek. If we did not have DeepSeek announcing that they were able to train AI for far less money, do you think that the street would be as disappointed in the increased CapEx on AI from the likes of those hyperscalers?
I think it's going to add some volatility because I think there's a lot of confusion in what DeepSeek actually did. Whether or not they trained full-fledged model that looks similar to some of the large LLMs here in the United States. For the amount of money that they've said is up for debate. We think that there was a lot of investment into the model and other things that the company did over in China to get to where they are today. But having said that, the big takeaway for us is that AI is getting more efficient. Large language models are going to get more efficient. But as that happens, we think that the demand for AI is going to move up and move higher. And so what that means is there will be more compute demand. We haven't even started, in our view, to see real inference workload, rollouts in enterprise, broader enterprise, and government use cases. And that's a long-tailed investment cycle that we think is going to drive a lot of compute demand. So I think we're going to have a little bit of volatility around the debate as what the DeepSeek really means, over the next several months. But I think, again, as you look at the CapEx numbers that are coming out, we're going to have NVIDIA report at the end of the month, and we'll have a lot of other ecosystem companies reporting like Broadcom, Marvell, and others. I think this will all work out as we flow through 2025. We're still big bulls for the AI trade.
Ruben, putting NVIDIA aside for a second, putting AMD aside for a second, just given what you said about DeepSeek and maybe the fact that it could be a catalyst here and likely will be a catalyst, more broadly speaking, for that AI trade, what are some of those underrated names within your coverage that you see ultimately getting a huge boost from this in the long run?
I think investors should be looking at networking stocks, whether or not, we're moving, further out to the edge, and we'll have, the ability to do more AI related workloads on our edge devices, smartphones or PCs, notebook computers, et cetera. The network, the underlying plumbing for moving data is going to get more challenging to put into place. The interface speeds are moving higher, and the challenges of moving data around, can continue to get, more complex. In the meantime, there's a smaller handful of companies that are participating these days. There's been a lot of consolidation in the networking space. So on our list, we really like companies like Coherent and Lumentum, which are reporting this week. Ciena, which has traditionally been selling optical networking gear into telecom service providers, is now starting to see a lot more demand from hyperscalers as AI-related data bleeds out of the data centers and out into the enterprises and consumers that are consuming AI. And then we picked up coverage of a company which is an EMS company which builds switches and servers for hyperscalers. We just picked them up last week, earlier this week, called Celestica, ticker CLS. And that's another one that we believe is going to be a very big beneficiary as we move into either custom compute, so the custom chips that the hyperscalers are designing and developing, and then companies like Celestica will put those chips into systems or rack-based systems, or they're also doing switch devices, which are part of this networking theme that I just discussed. And so, networking, I think, is something, an area that absolutely will benefit as AI workloads get more efficient to run.
All right, Ruben Roy, always great to get your insight. Thanks so much for taking the time.
Thanks for having me.
U.S. and Chinese stocks both lower this morning, although I'm not looking at too material of losses here. As investors digest the brewing trade tensions, you also got earnings that are ultimately the huge driver here in today's trading action. But joining us now on how this ultimately could impact your portfolio, we want to bring in Jay Pulaski. He's the founder of TPW Advisory. And Jay, we mentioned the trade war there, or the trade tit for tat, if you want to call it that, in the intro, just given the fact that I think it's caused investors to maybe second guess or reassess the investment opportunity, the landscape right now, whether U.S. equities are the best place to be. What do you think?
Well, we're adopting what we call the Stoic strategy here to deal with President Trump. So going back to the ancient Greeks, we want to anticipate everything and be surprised by nothing. And we also want to pay attention to what the president does, not what he says, because he says anything at any time to anyone. So we think he's focused on the tax cuts. We think tariffs are a money grab, and DOGE is a way to cut spending. We don't expect either to be very successful. So we see kind of a muddle through strategy in the U.S., which sets up an opportunity, we believe, for non-US equities to outperform.
So what trade does that initiate globally, Jay? Particularly when, to your point, we still don't have clarity on what these tariff policies are going to look like globally, and it keeps changing day to day.
Well, markets don't like uncertainty, right? That's the issue. And there's no uncertainty about tariffs. We've been talking about it for 3 months already. It's in the price. So when we want to pay attention not to the news, but to the reaction to the news. And so year to date, we look at things like Europe up 7%. We look at things like KWEB, the China Tech ETF, up 10%, massively outperforming the Nasdaq and the S&P. And so we think that's where the opportunity lies. We're overweight global equities in our global multi-asset model. We're double weighted commodities. We think commodities are very attractive because we think global growth is going to continue to expand. Commodities, in fact, are breaking out, supporting that view. And then we are very overweight emerging markets, and in particular, overweight China.
Jay, when you take a look at the price action this week, yes, we did see a bit of selling pressure, but nothing that was really a red flag, I don't think, for investors. And when you take a look at the performance of the VIX too, I think you could very much make that argument. What does that then tell you about how much is not priced in, that should be priced in, or maybe what that also more broadly tells us about the volatility picture as well?
Well, we've had a view for a long time that volatility was going to be very muted, and we think that continues to be the case. Look, what drives stocks are earnings, and earnings have been decent and look like they're going to continue to be decent. One of the worries is that if tariffs really do get implemented, U.S. earnings are going to be sharply reduced. JP Morgan just came out suggesting that the 25% on Mexico and Canada and the 10% on China could remove 2/3 of the earnings growth expected in the S&P this year. That would be problematic. And so that sets up our view, which is that really the opportunity is outside the U.S., where policy mix is likely to be better. We think fiscal stimulus is coming in Europe. It's coming in China. Both have fiscal space. The U.S. does not. And we think the big surprise, the really big surprise, could be that the dollar weakens and rolls over, which would be a strong support for commodities and for non-U.S. equities. The consensus call, strong consensus, is that tariffs are bullish for the dollar. We disagree.
Okay, we got to talk about that then, Jay, because you mentioned this bullish view on global equities, but I've wondered if foreign investment requires a stronger dollar that kind of reduces American exporting power, increases exporting power for competitors. How do you square that?
Yeah, our view is that American assets are priced for exceptionalism. They've been the big winners for the last 15 years. Everyone is massively overweight U.S. assets. Foreigners have never held more U.S. treasuries, never held more U.S. equities. And so the dollar is priced for exceptionalism. And what is the heart of American exceptionalism? Tech. And what just happened in the last week? DeepSeek, China Tech, basically just shot a hole through that whole thesis. And so to us, there's a massive rotational opportunity out of big cap tech in the U.S. into big cap tech in China. Because just like the U.S. is walling off U.S. tech from China access, China is doing the same thing. It's walling off the China tech space from U.S. companies. And so that tech space becomes the province of Chinese companies, which, by the way, sell at a 50 to 60 to 70% discount to their U.S. peers. And so for us, that's really the opportunity. And if the dollar rolls over, if that exceptionalism, right, gets called into question, if there's policy chaos in the U.S., which just look at the last 2 weeks, right, pretty much chaotic, versus better policy in Europe and in Asia, and money starts to rotate out, right now people are massively overweight and long the dollar. There's lots of room for the dollar to weaken, start to feed on itself. It supports commodity prices. It supports non-U.S. Equity performance historically. And we believe that you're going to have a single-digit return year in the U.S. and a double-digit return year in the non-U.S. equities. And so far, year to date, it's only 1 month, but ACWI ex-US outperformed the S&P in January by 120, 140 basis points.
So Jay, just given all that, have we seen a peak yet?
Peak in what?
In the dollar, in the strength, just given the fact that, yes, we are coming off those highs. Yes, there is a case, and I'm following it just in terms of the weakness that we could potentially see here going forward. But has it peaked? And I guess what would then trigger some of that weakness that you're then talking about?
Yeah, I mean, we're not traders at DBW Advisory. We're long-term thematic global macro investors. And so, whether the DXY has peaked, I don't know. Is it close to peaking? I believe so. Could it fall significantly? Let's call it 107 now, 107.50 this morning. It was at 110 a couple weeks ago. So maybe it has peaked. But, downside risk is to 100 and maybe below. And you look at things like the yen, right? We think Japan could be the trigger for this. What we call the capital repatriation trade. We think that term, capital repatriation, is going to be a big term over the course of this year. We talk about reshoring jobs, reshoring production. The next thing is reshoring capital as capital flows out of the U.S. back into the rest of the world to fund their efforts in AI, their efforts in climate mitigation, their efforts in defense. And so that's where we think the big opportunity is. Yen dollar at 150, fair value is 110, 100. It could move massively.
Jay, always great to speak with you, and an interesting call doubling down on global trade while we are still seeing the U.S. exceptionalism narrative sticking here in the U.S. Thank you so much for joining us. Appreciate it.
Always a pleasure. Thank you.
And sticking with the U.S., China and big tech. Reporting from Bloomberg saying that China's antitrust watchdog laying the groundwork for a potential probe into Apple's policies and the fees it charges its app developers, potentially looking for as much as a 30% cut from Apple and its app developers in order to continue operating here, also barring external payment services and stores. We should mention, of course, Shauna, that this has been in conversation over the last year here. This agency has been looking into and speaking with Apple executives about potentially charging Apple for these fees. So this is not necessarily directly related to the tariff tit for tat that we are seeing, though perhaps it is an additional tool in China's toolkit as they kind of ratchet up this tit for tat with the United States amid this trade war. And of course, Apple is not the only U.S. tech company that China is weighing probing right now. Yeah, of course. And given the long running disputes that it has had with some of the large tech companies or large companies within China, when you take a look at ByteDance, when you take a look at Tencent Holdings, clearly this is a conversation, like you said, it's not new. It's something that has been going on. But it does beg the question, just the challenges that this then presents for Apple in China. Just talking about the significance of China, obviously very important. It's the most important region outside of the U.S. there, just in terms of growth and the revenue opportunity for the business right now. So any sort of crackdown on exactly what that looks like, uncertainty there. Clearly, it is an issue. We're seeing that reflected in the market price here this morning. Shares had been off just about 3% in earlier trading. You're now looking at losses of just less than 2% here, 1.7% decline. So we are seeing a bit of a bounce back, at least off of the lows here of the morning. But again, this just also brings to the forefront the question about what this tit for tat trade war is going to look like. You talk about potential backlash, how China is going to respond to a further crackdown here from the Trump administration. This targeting here potentially, we should say, of other larger cap tech giants. Clearly a concern here for investors and something that needs to be kept in mind as we talk about that trade playing out here over the next several months. And to your point, in terms of the impact on American investors, or investors in Apple, I should say, we have seen Apple's revenue coming from China declining here. You can see that on your screen after hitting closer to a peak a couple of years ago. It's been coming off its highs over the last 4 quarters here. And we also know that China has been weighing a probe into Alphabet as well, which has not been operating in China since early 2010. So it's interesting to see which companies they're going after and why, given that these are companies that have already tried to kind of insulate themselves from the impact of China's weakening economy as well. And also their interest into NVIDIA too, which was announced back in December. All right, coming up, we're taking a look at some of today's trending tickers, including Snap, why the social media company's advertising overhaul is paying off. That's coming up next on Catalyst.
Now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Snap reporting better than expected fourth quarter results with revenue climbing 14% from a year earlier. Social media company benefiting from improvements to its advertising business, yet we're looking at shares off about 6%. It's always a volatile stock here surrounding earnings. Let's bring in Jasmine Enberg, eMarketer Vice President and Principal Analyst. Jasmine, when you take a look at the results that we're getting from Snap, you make the case that its efforts here to revamp its ad platform are paying off. What do you attribute then some of the trepidation or hesitation that we're seeing in the market then this morning?
Yeah, well, all eyes really were on Snap's top line revenue growth yesterday, and Snap did not disappoint there. It now has 4 consecutive quarters of double-digit growth within its ad business, and as you mentioned, that has to do with the efforts that it made to revamp its advertising platform as well as diversify its revenue streams through subscriptions like Snapchat Plus. I do think one of Snap's weak points continues to be in brand advertising. Historically, there have been a lot of large advertisers on Snapchat, and we saw some weakness there again in Q4, which of course it had warned about back in Q3 as well.
And what are you making of the success of Snap's subscription service in particular? How are they being able to win on that versus some competitors that are struggling still?
Yeah, Snapchat Plus really is a huge success story for Snap. It's rare to see a social media company have a successful subscription service. I think one of the things that Snap has figured out is the correct value exchange. Snap may not have the biggest audience of the social platforms, but it has an incredibly loyal audience. Those who use Snapchat really love it, and it's clear that they're willing to pay for some of the new features and tools that Snapchat Plus provides. And, you know, the revenue rate for Snapchat Plus really has been ramping up. And what was really fascinating to see in Q4 earnings was that now Snapchat Plus revenues accounted for about 10% of its overall revenues, which is a meaningful number.
Yeah, Jasmine, when you take a look at the outlook, I think that's really what the street is taking issue with, some of the mixed guidance that we are getting here from the company. I'm curious, and I want to bring up a point that I saw in Citi's note here this morning. They were talking about engagement, talking about some of the progress that has been made. The direct response to ads are improving, but then they talked about the fact that visibility remains somewhat limited. I'm curious how much of an overhang you see that being for the stock, at least in the short term.
Yeah, I mean, user engagement is one of the key metrics that advertisers are looking for when they're deciding where to allocate their budgets. Snap did see some improvement in time spent with content, and it is making some big changes to the user experience, including a simplified Snapchat experience that now has one entertainment feed that it believes will ultimately drive more engagement. One of the things Snap has also warned about is potential disruptions as they're rolling out these changes. That's something that we see all the time when a social media platform introduces a new feature or overhauls the user experience. I ultimately do think that we're going to see more engagement come in that way. I mean, you know, video makes up such a huge portion of the time that we spend on social media, 60%, in fact, according to our estimates at eMarketer for average daily time spent. And so a heavier focus on video will ultimately be, you know, positive for Snap, especially as we're seeing a lot of volatility among users and creators and advertisers around the potential of a TikTok ban.
Well, talk to me about that in context of the company's outlook as well and the challenge that might be presenting, at least in the stocks trade today. To what extent would a TikTok ban potentially reverse some of that pressure for Snap?
Yeah, well, Snap stands to be a potential beneficiary of a TikTok ban. We're already seeing it start to benefit somewhat from the volatility and the uncertainty around TikTok. Advertisers and creators are actively looking for alternatives. They're looking for ways to diversify their strategies, and Snapchat is at the top of the list for a lot of them. Ultimately, I do think that, you know, YouTube and Meta will be even bigger beneficiaries than Snap, just because their services tend to be a more natural fit for users and creators and advertisers. But as Snap is making some of these big changes, including, again, the entertainment feed that we already talked about, it's going to become a more attractive place. And Snap, like the other social platforms, is really courting TikTok creators, because where creators go, users will follow. And one of the things we saw in January was a campaign by Snap, for example, about find your favorite creators, and really helping users to find TikTok creators, particularly on the platform. And of course, there's the Snap Stars program, which helps creators earn money from the platform. And there's really no better way to get creators to a specific social platform than helping them make more money.
All right, Jasmine, we got to leave it there. Thank you so much for joining us. Appreciate it. Another trending ticker here, Tesla. Sales in Germany plunging nearly 60% last month. Just 1,277 cars were registered. Its lowest monthly total since July of 2021. That's according to the German Federal Motor Transport Authority. Tesla sales also dropped double digits in France and in the UK in January. And I think it's important to put these numbers into context for Germany, because the country has been struggling economically. You may think that sales are down across the board, but it appears that this is specifically about Tesla, because the EV market was up 54% for the month in Germany specifically. So that does suggest that perhaps it's something specific to Tesla. What's been going on at Tesla? Elon Musk has been throwing his support behind far-right candidates in Europe and specifically in Germany as well. So perhaps that is one factor that is driving a little bit of the consumer switch when it comes to EV purchases in Germany.
Yeah, exactly. It's also important to put into context just in terms of how many vehicles they are selling too, right? So it's a fraction of Tesla's business as well. When you take a look at how many cars were sold in the month of January, just over 1,200 here. So putting that in perspective, yes, it is a dramatic drop when you're comparing it to the numbers that we saw just about a year ago there. But clearly, though, it's a small portion of that business. But again, when we talk about the risk of backlash here from a very vocal and outspoken CEO, I think this is one of the reasons, or one of the cases, that you are seeing that playing out in real time. Now, obviously, if something anywhere close to this were to happen in the U.S., it would be a much different conversation. It would be a much bigger hit here, and you would see a much broader or a more significant reaction than in the stock price here. This morning, you're looking at losses of just about 2.8%. But again, when you take into context maybe ultimately what this means, especially for the popularity beyond even Germany and throughout Europe, there are some questions that are surfacing this morning just in terms of, I guess, worry about whether or not this is going to spread to some of the countries beyond Germany.
And how much of it is that macroeconomic challenge versus the company itself, to your point, Shauna?
Finally, Chinese e-commerce stocks like Pinduoduo and Alibaba, as well as JD.com, are pairing some of their earlier losses after the U.S. Postal Service announced that it will continue accepting inbound mail and packages from China. This comes after the Trump administration announced that it would close a century-old rule allowing packages worth under $800 to be shipped into the U.S. duty-free. The U.S. Postal Service moving to comply Tuesday night, announcing package suspension from China, which they've now reversed. Let's talk about all this and more. We have Yahoo Finance senior reporter Jordan Weissman. Hi, Jordan.
Hey, thanks for having me.
Jordan, let's talk about ultimately what this means. The fact that we saw such a quick reversal. Mm-hmm. What type of uncertainty does that introduce? And I guess how should consumers then be looking at the developments here of the last 48 hours?
Well, stepping back, it turns out that this might be the big story to come out of all the craziness around Trump's tariffs over the past week. At first we thought it was going to be all about Mexico and Canada. Now it's actually all about China, and specifically how he has closed what's called the de minimis rule, which was what allowed companies like Shine and Temu to massively expand their business in the U.S. Now it went from maybe slightly over 100 million packages like these coming into the U.S. each year to 1.36 billion per year, right? It became a enormous business. The U.S. Postal Service, it is obviously struggling to figure out how it's going to comply with the end of this rule, because it has to now inspect all these packages. You need manpower to do that. It's a huge challenge. And at first they just said, no, we're not going to allow anything in. Now, clearly they think that may have been an overreaction. We'll see how they adjust. But people are watching that carefully. Looking beyond that, for shoppers, this could make shopping on these buying things on these platforms quite a bit more expensive. There was an economics paper written before these tariffs went into place that found that this could be adding over $20 to the cost of a package, not just because of the tariffs themselves that they might face, but also because each time something has to go through customs, there are all sorts of fees that are associated with that. Not only that, but you have to pay someone usually to handle that process, and that costs money. So this could put a huge dent in Shine and Temu's business and maybe change the way people are shopping at the moment.
Yeah, and certainly a challenge when sticky inflation has already been a struggle for consumers. Jordan, thanks so much for joining us. Appreciate it.
Thanks for having me.
Coming up, we'll get analyst reaction to Disney's latest earnings results. That's next, right here on Catalysts.
We're managing the business in a way where we're trying to grow subs and we're trying to improve margins at the same time. We feel like we've got the right formula to grow subs and at the same time hit the $1 billion plus financial goal we set out for ourselves.
That was Disney CFO Hugh Johnston on the company's strategy for growing its streaming business going forward as it looks to compete some of the giants out there like Netflix. Now, Disney did lose subscribers to its flagship Disney Plus service in Q1, and you're seeing that reflected a little bit here in the stock this morning. You're now looking at shares reversing some of those earlier gains, now off just about 1.7%. Let's bring in Geetha Ranganathan. She's a senior media analyst at Bloomberg Intelligence. Geetha, it's great to have you back here on the program. So what is your takeaway from these results? When you take a look at the top and bottom line, there's a lot to be encouraged about. The commentary was very upbeat, yet when you take a look at the subs number, it is a little bit disappointing.
Yeah, thank you so much, Shana. Thanks for having me. So I think it was really a strong quarter for Disney. I think the strength was broad-based across all of the major divisions that we're tracking. Parks definitely came in much better than we expected. Streaming profitability, again, well on track as they build towards that goal of $1 billion in profit for fiscal 2025. You did mention the subs number. Now, remember, it is actually much better than what both the street and what kind of the company had guided to. So one of the big things that we were kind of anticipating as we came into this quarter was that there was going to be a lot of sub losses because there was almost a 15 to 25% price increase on the Disney Plus streaming products late last year. And so the company had also expected, more people to kind of cancel the service, but actually it was fairly contained. So we saw a loss of about 700,000 subscribers. That was way better than some of the losses out there, which were, projected to be upwards of 2 million.
And Geetha, taking a look at your note, you mentioned several potential positive catalysts for Disney in 2025. I'm just curious your reaction to the stock reversal that we are seeing. Obviously a lift right after the results, but now we're seeing the stock off about 1.5%. Do you think that's about that subscriber growth, or is there something else that folks are worried about today?
Yeah, so Maddie, I think with this company, they did reaffirm guidance for high single-digit EPS growth. But I think what the street was expecting and what investors were generally hoping for was that they would take guidance up a little bit, especially kind of given the strength that we saw in those fiscal first quarter results. If you just look at adjusted EPS, it was up over 40%. So I think a little bit of disappointment there, just given that they only reaffirmed guidance and didn't necessarily take it up both for the parks division as well as for overall earnings per share.
Geetha, Brian Sozzi had a conversation with Disney CFO Hugh Johnston earlier today. We played a soundbite of that just a moment ago, but he also asked him about pricing, and this stuck out to me. Here's what he had to say, and then I want to get your reaction on the other side.
My expectation is that the value that's delivered in streaming, even compared to cable right now, is so strong, both in terms of price as well as the consumer experience. I think over time you're going to see pricing continue to rise in the coming years on streaming.
How much wiggle room do they have on pricing, do you think, going forward?
Quite a bit. If you're a service like Disney Plus, if you're a service like Netflix, you are a must-have service. And I think people are willing to pay if they have content that that people like. So that's exactly what we're going to continue to see. I think both from Netflix and Disney, they're going to continue to raise prices, and that's going to flow through to the bottom line. So if you just kind of think of the average price of a cable TV package, Maddie, I mean, it's anywhere from about $80 to $100 per month. You still look at the Disney Plus service or the Netflix service priced at about $20 to $22. It's really good value for money. And even if you add in all those services, again, I would say it's good value for money. So there is definitely a lot of pricing power that some of these bigger services have, and especially with Disney, because they have the option of bundling. Now, that's something that Netflix doesn't necessarily have, but Disney has that with Disney Plus, with Hulu, with ESPN, the flagship ESPN product that will debut a little bit later this year. They're going to be able to bundle all of those together and offer really good value, I think, for the consumer.
And Geetha, the CFO in some of his conversations this morning really throwing cold water on the idea of any potential policy impact, whether that be from tariffs or any sort of global geopolitical tensions, putting pressure on experiences and park spending globally. How are you thinking about the risks of policy on Disney? Are they as insulated as they're making it seem?
I think they're fairly insulated because majority of the profits, yes, international parks is a big contributor, but if you just kind of look at the revenue breakdown, I mean, you still have domestic parks, which makes up almost 70% of revenue. International is much smaller at about 17 to 18%. So yes, they're an important part of the profitability story. They're an important part of the whole experiences segment. But I think that definitely the impact from any tariffs or any trade tensions will definitely be very contained.
All right, Geetha, got to leave it there. Always great speaking with you. Thank you for making time for us.
Thank you.
Coming up, the potential impact of tariffs on U.S. automakers. Why our next guest says it's only bad news for two companies. We're going to tell you those next, right here on Catalysts. Nissan and Honda reportedly scrapping merger talks. That proposed deal would have created the world's third largest automaker. Joining us to discuss the implications, David Whiston, Morningstar's equity strategist for U.S. Autos. David, great to speak with you here. What is your reaction to the potential unwinding of this deal?
Well, just to be clear, I don't cover either company. It's a colleague. But when it was first announced just before Christmas, I was a little, I guess, a little bit skeptical. I think like a lot of people who watch the industry were, because there wasn't a whole lot of benefits of really combining. It seemed like Nissan needed the deal more than Honda. So it's, and then there were media reports last night that basically Honda wanted to be the overlord, so to speak, in the deal. And I think Nissan understandably doesn't like that. So now that it may be falling apart. So I guess that's not surprising.
All right, let's talk about, more broadly speaking, the tariff story, because that's something that I know you have been closely tracking. Yahoo Finance had the opportunity to speak with Ford's CEO, Jim Farley, late last week, ahead of everything that played out over the weekend, asking him just about the impact that tariffs could potentially have on the industry. Let's take a listen to what he had to say, then I want to get your reaction on the other side.
Well, we think this will play out over the next couple months. And Ford has the largest U.S. manufacturing footprint. And so we're really encouraged about the administration's positive outlook on the auto industry and the impact on our overall economy. And we're really looking forward to working with them in a positive way so that we can get better outcomes to employ more people in the U.S.
David, how much of this has been priced into the risk here for these auto stocks?
Yeah, that's a bizarre one, because Trump came out on November 25th with a social media post saying he was going to do this. Then on the night of his inauguration in the Oval Office, he said on camera, I think February 1st. And then the market really didn't freak out a lot in between inauguration and February 1st, which seemed odd to me. And then we had a huge freak out initially on Monday morning, as we all know. I think GM was getting hit on November 26th, so I think some of this is priced in, but there's still a massive amount of uncertainty because nobody knows how long these tariffs last, if they even do come to fruition.
How justified is some of the selling that we're seeing then? I want to throw up a chart of a GM stock, if we have it here, over the last 5 days, down about 5%, over the last month, down nearly 10%. Is that selling justified for these automakers given the policy uncertainty?
I think if you believe the tariffs are going to last, say, all of Trump's term or even beyond Trump's term, then yes. I think it's more likely a deal gets worked out. If you look at the terms of the executive orders on Monday for all three countries, China, Canada, and Mexico, that the White House put out, they're all about, in a word, drugs. They're not about trade. So it's about, can we get a deal done around drugs and probably also illegal immigration. And in that case, the tariffs probably don't last a long time if a deal can get done. And then in that case, you can go back to business as usual, for lack of a better word. And yeah, Jim Farley is right. They have the most U.S. exposure. But what doesn't get talked about enough is all the parts exposure. These tariffs are not good for anybody.
David, given that, how should investors be thinking about this? Who is then best positioned?
Well, purely on vehicle assembly, Ford is very well positioned. I think overall in the industry, I think Tesla has the highest American parts content, though. And that's the thing. Everyone loses here, because even if you make most of your production or even all your production in the United States, you're using, say, wire harnesses from Mexico, or you're using various parts, seats from Mexico, or something from Canada. Parts cross the border 7-8 times before they end up in a finished vehicle. Remember, North America has been a tariff-free zone since 1994. The auto industry's had some kind of tariff exemption back to the mid-'60s. There was some piece of legislation. So you can't just disrupt that immediately and then pivot and revamp your supply chain in a few days. It takes billions of dollars to revamp, because you'd eventually have to add brick and mortar, and that can take a couple of years.
All right, David, thanks so much for taking the time. Coming up with the latest big tech sell-off, we're breaking down the latest trends in ETF investing and what could help you potentially avoid some of that volatility. That's coming up next. So far this year, tech has been underperforming, especially when you compare it to some of the other major sectors. You can see it on your screen. It's underperforming healthcare, it's underperforming energy, as well as the broader S&P 500. Now, amid this recent selling in tech and some of the downward pressure that we've seen in the broader market, how can investors use ETFs to best protect their portfolios? Joining us now as part of today's ETF report, brought to you by Invesco QQQ. I want to bring in Johan Gran. He's Allianz Investment Management's head of ETF market strategist. Johan, it's great to have you here on the program. So talk to us just about some of that selling pressure that we are seeing play out within the market, given so much uncertainty right now. What is the best way for investors to protect their portfolios?
Yeah, and it's the key word is investor, right? If you're a gambler, you take different bets and you place them on a daily basis, perhaps. But if you're actually investing, you want to make sure you have some level of protection, unless you can afford to be either a gambler or somebody who's investing all of your assets in 100% of the in equities. So what we see a lot of is when we have advisors and clients facing retirement and that are in retirement, they're looking for a level of protection. They're not looking to hit the ball out of the park, so to speak. And that's really the main focus, because you have investing periods that stretch for years, not for days. So unless you can afford to gamble or take all the equity market risk, then you need to think about how you're protecting your assets.
I guess the hard part is what gambling looks like, right? And it's interesting because we've obviously continued to see record inflows into large cap tech ETFs, including the QQQ, which you can see on your screen here. Compared to Mag 7 performance, you can see right after January here, a huge inflow into the QQQ, and then the Mag 7 started to underperform. So where can investors find safety within ETFs, if not in tech?
Yeah, so there's a relatively new type of ETF on the market. It's new. It's been around for over 5 years by now. But buffered ETFs, or defined outcome ETFs, they're also known by. They provide you a protection level that you decide. Frankly, you can decide whether you want 10, 15, or 20% protection against the downdraft of the S&P 500. So to keep it simple, if you're putting money to work, let's say $1 million into a buffered ETF with a 20% protection level, over one year period, if the market is down by 20% or less, you still have $1 million net of fees at the end of that 1 year period. And then in terms of the upside potential, you can make up to approximately 10%. So we see a lot of people that are saying like, okay, I like that bet. I'm not investing the way that my perhaps grandparents used to do with fixed income and trying to squeeze some yield and income from the bond portfolio. They're looking to build the protection into the portfolio, but still not giving away all the upside potential.
Johan, how should investors then be looking at what sounds like the upside cap to that?
So the upside cap, in terms of what you can expect, right? It's always compared to what you would have otherwise bought. So you take the simple case for when people retire and they start thinking about risk more than perhaps equities. Traditionally, they've been moving over to core bonds. And the idea has been that you want to get some type of upside from the bond so that you can live off of that. You can't do that anymore, really, because the income isn't quite there. And the protection isn't always there. You think about 2022, for example, when both equities and bonds were selling off. So in terms of upside, it's always relative to what you would have bought. And if you would have bought core fixed income, you might be happy with 5, 6, or even 10% upside. So in the case of a 20% buffer, you can make up to 10% on the upside. If you have a 10% buffer underneath you, the payoff might be up to 15%. So give or take 3 times as much as the bond market might give you. And if you're not happy with that, then you can also buy a 15% buffer with uncapped upside, where you give away about 3% of the first percentage points of the equity market, and then you get to keep all the rest.
In the example that you had just given us, though, Johan, you said that if you invest $1 million into buffered ETFs, you would still walk away with that cash, even if the market had up to a 20% drawdown. But that's not necessarily true when you take into account the higher fees associated with buffered ETFs. How do you talk clients through that expensive piece of buffered ETFs?
Yeah, sure. So the upside, again, is like if you're happy with making up to 10% in this particular case, the fees are really not that extraordinary. The fee is really the expense ratio of the ETF. The ETFs that we have at Allianz Investment Management, for example, they're all 74 basis points or 0.74%. So that's the actual fee. The return profile is what you decide on at the beginning of the outcome period, what you're happy to buy. And if you want, a certain level of protection, which is objective number one, is to protect your assets, and there's no free lunch. So the question is really, okay, how much are you willing to sacrifice on the upside, so to speak?
All right, Johan, thanks so much for taking the time.
You bet.
Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
It's time for Yahoo Finance's Market Minute. Stocks recovering some of their earlier losses as investors digest big tech earnings and trade tensions. AMD and Alphabet both sinking after their earnings fell short of expectations. Alphabet reported slowing cloud growth as it ramps up AI spending. Meanwhile, AMD issued a disappointing data center sales forecast. Uber shares falling on a softer than expected outlook for its current quarter. The company saying currency headwinds and severe winter weather could impact rides and food delivery moving forward. Disney shares lower after initially rising in pre-market trade. The company beat expectations in its first quarter as streaming profits offset losses in its park business. And that is your Yahoo Finance Market Minute. For more on what is trending more broadly on Yahoo Finance, you can scan that QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, the latest read on the labor market. We break down the number of jobs added in the private sector last month. And an egg shortage is ripping through grocery stores across the U.S. We'll talk to the CEO of Stu Leonard's about when we could see relief and what other things might affect your food prices. Plus, here's your daily reminder to start your tax paperwork. We'll talk about why such a deadline and such a headache to do taxes is here in the U.S. All that and much more coming up. But the private sector added more jobs than expected in January, reiterating the strength of the labor market and allowing the Federal Reserve a little leeway as they weigh their next policy decision. Here to dive into the report and what it means for the economy and your job hunt, we've got Neela Richardson, who is the chief economist at ADP. Great to have you back on the program with us. So let's just walk through the takeaways from this particular ADP jobs print and what it spells out about the broader labor market right now to begin the year.
Yeah. Hi, Brad. Good to see you. And there's good news in the labor market. It's showing the same kind of strength we saw at the end of 2024 is carrying through that momentum, and hiring is carrying through into the first month of 2025. So solid across the board in terms of the headline numbers. But when you peek underneath the surface, you see a real dichotomy underneath that strength. Most of the jobs were created in the service sector. The goods sector, manufacturers are struggling. We saw a decline of 13,000 jobs in manufacturing, and construction only increased 3,000 jobs. That's a notable downshift. Where we saw strength are those consumer-facing sectors like leisure and hospitality. So if you want to know everything you need to know about the labor market, follow the consumer, because the businesses that support consumers and in consumer-facing industries are the ones showing strength right now.
And then the pay side for the consumer, as we're kind of thinking through the pay and that reading that came in there, 4.7% annual pay was actually higher. So how does that kind of take us further into where the consumer is trying to continue to outpace inflationary pressure?
So, and we're going to draw that sharp contrast between consumer-facing industries like leisure and hospitality and more business-oriented industries like information or professional business sectors. And so what we're seeing in terms of overall wage growth, and we're able to really measure this rigorously because we have actual paychecks, is that for people who've been on the job this time last year versus this year, they're seeing a 4.7% increase in pay over that time period. Now, that's notable because we haven't seen that number budge over the last several months. It's been 4.7% for a while. This contrasts a lot from last year, where that number was declining consistently. So wage growth is kind of stuck at this higher level. That's good news for workers, but it could be a challenge for the Federal Reserve because labor costs aren't going down. They're staying stuck at higher levels, which translates into sticky inflation.
Now, of course, towards the end of the year and then the beginning of the year, we typically monitor pay very closely as well for those who are job stayers and looking for a pay bump, or those who might be job switchers and ultimately looking for a new gig and being able to perhaps start a new role at the beginning of the year. What are we seeing in terms of the dynamics that are playing out in this most recent print there?
So we're seeing that job changer growth is up 6.8%. So it still pays to switch on average, according to this data. But this premium between job stayers and job changers is lower than it was during the 22 Great Resignation, when jobs were plentiful and workers were switching a lot. We've seen that workers are now staying in place. If you look at government data, there's a lower level of quits. And the jobs market, it's good, it's solid, but it's taking longer for those job seekers to find that next role than it did 2 years ago. So this is a much more normal labor market where it takes time to find a job. And you're seeing that play out in elevated wage growth, but not nearly the gains that you saw in 2022 from job switching.
You know, that's particularly interesting because as we continue to see that narrow, what would be the warning signs to say that it would actually kind of flip over, and ultimately, what would that spell out more broadly about, especially as the Fed is thinking about their dual mandate, spell out more broadly about the labor market health?
Actually, we have seen that, Brad. We've seen it in leisure and hospitality. It is the one industry that we track where you actually see higher pay growth for people who stay on the job than people who switch. And that's namely because it's an industry where wages are rather low. So for low wage sectors, they're vulnerable to seeing this switch where the current labor market is not as rewarding as the current job. So what that would mean for the Fed is we'd be transing into stagflation territory because wage growth is necessary in terms of growth. And if you're seeing wages stagnate or even reverse, that's going to be consistent with an overall business sector that's not moving forward. So we don't want to see that. We want to see continued steady wage growth along with productivity enhancements that lead to overall healthy business activity.
Nayla, great to see you. Thanks so much for taking the time here with us. Appreciate it.
Thanks for having me.
Let's take a look at some of the market action. We are 90 minutes into the trading day. Stocks, they are, well, major averages are mixed right now as we're taking a look at the Dow higher, the S&P 500 and the Nasdaq lower though. As tech drags, disappointing results from Alphabet and AMD certainly weighing on the broader markets here, and especially the tech sector. Joining me now, we've got Sam Stovall, who is the CFRA Chief Investment Strategist. Sam, great to have you on the program with us this morning. How should investors be evaluating tech and that trade right now?
Hey, Brad, good to talk to you again. Well, technology is one of the three sectors within the S&P 500 that's trading below its 50-day moving average, but just, slightly. I would tend to make a read of that all of the other sectors are doing fairly well, that what we experienced on Friday and Monday was really just a pretty short-term reset, and we had technology as among the leaders toward the end of the day yesterday. So I think that there's probably going to be a little more softness in the technology space in the near term, but we're maintaining our overweight recommendation on the sector and think that it will be recovering by year end.
You know, Sam, for the kind of 1,000-foot level or perhaps 10,000-foot level, just this kind of blanket question has continued to emerge at the start of the year. Ray Dalio brought it up about a week ago as to whether or not we're starting to see formulation of a bubble and any bubble bursting potentially. And as you mentioned, some of the slippage between that below that 200-day moving average, I tend to wonder, at what point would we be flashing some of those warning signs?
Well, we've been talking about bubbles. When I say we, meaning the marketplace, has been talking about bubbles since last summer. There was a point in which technology was trading at a 78% premium to its 20-year average forward PE ratio. The market itself was trading at more than a 40% premium. That's been trimmed quite a bit. We are looking right now at the S&P at a PE of below 23. Certainly that is higher than the 10-year average of 19. So that puts the market at a 20% premium. But tech has been coming down and now moving much closer to its more normal PE relative PE range. So, I would tend to say that, yeah, we probably could do a little more digestion of gains in technology, but it's also expected to be one of the strong areas of growth in earnings in the year ahead. And I don't think we're going to be seeing a lot of PE multiple expansion, but if we do get the earnings growth that is projected, then tech could continue to be an outperformer.
What is the earnings bellwether this season that would give further fuel to the fire for tech being that outperformer?
Well, I think the shift has gone from the semiconductor area. Of course, everybody's going to be looking at NVIDIA, but I would tend to say that software is more of an area that could be of concern. I mean, when we started this reporting period, financials in general, banks in particular, were the bellwether. And instead of getting a 35% year-on-year rise, we ended up with a 55% year-on-year gain for diversified banks. So I would tend to say that we still need to see some improvement in the semiconductor and in the software area in order for hopes to remain alive for technology.
As you're laying out your strategy for the rest of the year, and even with some of the broader bullish sentiment that continues to try and find new places to invest this year, what are some of the top themes that you think we're going to be set to see play out, not just for the rest of the quarter, but perhaps for the rest of the first half of this year?
Well, I think volatility is going to be part and parcel of any theme that one would be looking at. Traditionally, in year one of the presidential cycle, we see a very large number of, or about a 90% frequency of falling by 5% or more, actually with the average decline being about 17% going back to World War II. Reminding everybody, however, that it only takes about 4 months to get back to break even from a decline of up to 20%. I think also that the earnings growth is expected to be a theme because, as I mentioned before, PE multiple expansion is not a likely driver in the market. And if we're expected to see about a 2.5% rise in GDP this year versus 2.8 in 24 and a 2.2% projected for 2026, I think we're going to need also to see some profit margin improvements in order to sustain these higher valuations.
Sam, while we have you here, there was a Schwab study that was out saying about 15% of U.S. stock market investors started investing in 2020. That means that 15% of the investors in the stock market may not have been invested or may not have had any skin in the game when the previous round of tariffs and the previous Trump administration was enacting those tariffs and that tit-for-tat trade war was going on. What is the tariff playbook for those investors that are newer over these past few years?
Well, I think what it reminds investors is that you don't expect the market to go up every year, because if they started in 2020, well, that certainly was a bear market year. Then in 2022, the market was down 19.5% for the full calendar year. So I think these investors have learned quite quickly how volatile markets can be. And as we move into 2025, seeing once again the uncertainty and what kind of driving force that has on investor sentiment and on share prices themselves, but also probably causes them to pay a little more attention to technical analysis to see where the trends are, what the support levels are, and what the likely growth rates could end up being.
Sam, thanks so much for taking the time here with us today. Really appreciate it.
Always a pleasure. Thanks, Brad.
Thanks. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Uber sliding after issuing a first quarter bookings outlook that disappointed analysts. The rideshare company cautioned that currency headwinds and winter weather could impact trips in the current quarter. Some analysts still see strength, with one saying Uber faces high expectations, another saying it remains well positioned, and another pointing to improving fundamental trends. Next up, we're checking in on shares of Mattel, popping on a Q4 earnings beat and reporting profit guidance for the full year above analyst estimates. Mattel expects improving Barbie trends in 2025 and expects another record revenue year for Hot Wheels. They are citing elevated inventory as a potential headwind this year. And finally, here checking in on Workday. It's rising on its restructuring plan. The cloud platform says it will cut 1,750 jobs, about 8.5% of its current workforce. It expects to incur between $230 million and $270 million in charges for its plan. Now, the company's CEO writing in a note, quote, "The environment we're operating in today remains and demands a new approach." Workday does intend to hire more workers in strategic areas like artificial intelligence. Coming up, are eggs scrambling your grocery budget? We're getting to the bottom of those prices increases after the break. Home buyers are finding little reason to jump into the spring selling season, even with more listings coming up for sale. Now, let's bring in Yahoo Finance's Danny Romero with more. Danny, what do we know?
Brad, buyers are still dealing with high mortgage rates and high home prices. According to data from Mortgage Bankers Association, mortgage applications to purchase a home fell 4% last week compared to the previous week. Now, demand remains flat compared to the same week a year ago. So what's going on here? Well, mortgage rates just haven't dropped enough to really spur up that demand. Now, separate data from Realtor.com shows that 15% of sellers offered a concession, like a price cut. Most sellers are still seeing enough competition to keep and hold their listing price. But another factor is that the supply of homes is gaining some traction, but homes are staying on the market a bit longer, Brad.
Denny, you're also tracking the rental market. What are some of the biggest challenges facing renters right now?
The rental market is bracing some challenges right now. According to data from Bank of America, the number of people that have moved has moderated and was down 1.6% on a yearly basis in the fourth quarter last year. Some cities like in the Midwest and in the Sun Belt are still seeing some growth. But remember, rental growth has eased over the last 2 years. But Bank of America found that the average rent growth is still accelerating in the most affordable zip codes. And also other separate data from Redfin shows that nearly 70% of single people are struggling to pay rent or their mortgage payment compared to married couples. And that's because when you're single, you are upfronting those housing costs compared to a married couple where you have two incomes that are upfronting those housing costs. Bottom line is that economists say that renters are going to see little relief in the near term because of the lack of supply and also the pullback in multifamily construction. Brad?
Danny, I thought you were about to say bottom line, just pay for the subscription, pay the fee on those dating apps. I appreciate it. Thanks so much for taking the time. Well, Waffle House is adding a 50-cent per egg surcharge to customers' orders amid an ongoing egg shortage prompted by bird flu. And that means egg prices aren't pretty. They're up more than 36% from the last time that we'd seen the December CPI report come through. And there you're taking a look at some of those month-over-month and year-over-years. The U.S. Department of Agriculture says that egg prices are projected to rise more than 20% this year. Here to discuss egg prices and much, much more, we've got Stu Leonard Jr., CEO and president of Stu Leonard's, a supermarket chain with 8 locations across New Jersey, New York, and Connecticut. Great to have you back on the program with us. Just
Thank you.
Take us into the egg pricing and the dynamics that you're having to wade through, as well as a power seller and sourcer of eggs.
Well, we'll sell, I mean, we sell like 100,000 eggs a week, right now. And it's something I haven't seen in my 50 years of being in retail. We have a family business, and I've never seen egg prices go like this. I was just talking to our farmer yesterday in Pennsylvania, and they basically have all of the hens locked down so they don't get outside. Because, like they say, the bird flu, birds are the ones that fly around that are bringing the flu to these hens. So they have them in lockdown right now, and the supply is down, so therefore prices are going to be up.
And so with that in mind, how long, how extended, especially given the lockdown measures that some of the farmers that you're working with have to take and the unknown of the spread and the continued spread of the avian flu, how long do you think that these prices could be elevated for?
Well, I talked to our farmer, Mark, yesterday morning, and he said he just went out on the market to buy some baby chicks because they have to replenish hundreds and hundreds of thousands of baby chicks now to grow them up. And he said they're sold out. You can't get any baby chicks. So there's going to be a little supply thing. He felt it's probably going to last, probably 6 months. It's going to go, the prices will come down a little bit. But I just put your seatbelts on. I think we have a big supply issue going on with eggs right now. It's uncontrollable with the flu. And I think that our customers just have to get used to an elevated egg price.
Do you think that's in line with the 20% that the USDA is forecasting?
You know what? That's just throw a dart. Nobody knows what's going to happen to the market out there, but it's not going down. I can tell you that much, because as supply starts to shrink like it is now, prices are going to go up. And also, like our farmer told me, he's got to do a lot of preventative things to prevent the flu from happening. So he has a whole bunch of extra costs that are associated with keeping his birds safe, which he's doing a good job at.
Yeah. Stu, let's talk about some other aisles in the store, of course, that you are able to make sure that you service customers through. We have a larger consideration around how chains like yourself are going to be able to navigate any potential tariffs. What are the considerations that you're needing to really run the calculus around now in order for supplying and sourcing and continuing to keep shelves stocked?
Well, the first thing we look at is we got to keep the shelves full. I mean, we did that during COVID. We toilet paper, it was like a big issue for some reason. But one of the things we were able to get it from South America, actually. We were able to have toilet paper. We're going to do the same thing with avocados. The only thing that might be a little issue is tequila. It's only made one place in the world, and that's Mexico. You can't source that anywhere else. And the third thing that we're working on right now is an alternate supply. That if the price and there's a tariff slapped on, say, salmon or lobsters coming out of Canada right now, or tomatoes on the vine, we'll have another source. And we're just planning on backup plans right now. I'm not doing anything different on pricing. I'm not doing anything different on panic buying or buying extra product. We're just taking it day by day right now. And, who knows what's going to happen there with the tariffs.
And so to your best estimation, would that be a price that you at Stu Leonard's would absorb, or how much of that has to get passed on to the consumer?
You know what? That's always a tough one right now, because I know, look, you just turn on the television set and you can see it's inflation and the cost of food and so forth. So we are really sensitive to giving good value to our customers. And it's tough because, like with eggs right now, if you go over like say a $4.99 or a $5.99 number, sales go down. Unless you're Prada or Gucci and you raise the price and sales go up. But so I end up, first of all, the phone call I get from the supplier is they got to raise their price due to this, and this. What I have done very successfully is say, I'll split it with you. It hurts our margins. It might hurt the farmers' margins a little bit, but we'll get through this thing. It'll be a temporary thing, and we've been doing business for 30, 40 years with a lot of these suppliers. So it's a little hump that we'll get through, and prices will stabilize and come back down.
Stu, a lot of considerations that you're juggling. We appreciate you taking some time here with us today, jumping back on Yahoo Finance.
If I could mention one thing, down in our Clifton store, you know what we're doing for fun on Friday?
What's happening?
We're having a Taylor Swift and Travis Kelce look-alike contest. Okay, whoever shows up and looks like either one of them, we're going to have a little voting thing, and you get a $500 gift certificate. If you look like Travis, you get $500 if you look like Taylor. So we're expecting like some fun. And the other thing is, a big thing is obviously these guys, right? These big grinders they have. We're doing one with the Philly cheesesteak sub. So we're trying to get in the swing of food and Super Bowl and guacamole and chips and wings. You guys out there have a great Super Bowl weekend.
Thank you so much. I'd have a lot of work to do to compete in the lookalike contest. However, I can certainly purchase a sandwich.
I don't think you're getting the $500 gift certificate.
I'll rule myself out of that one. I appreciate the time, Stu Leonard Jr. Thank you.
Okay. Thank you.
Thanks. Coming up, before the Chiefs and the Eagles face off in New Orleans, we're breaking down how hospitality companies are handling the costs of food for the big game. Let's get you a quick check of the markets. We are 2 hours into today's trading session and taking a look at the Dow Jones Industrial Average. It's been waffling throughout today's session. However, it is holding on to gains of about 0.1%. I'll give you an intraday look at how things are faring here. And this is exactly what we would like to call that waffle. All right. Also, taking a look at the Nasdaq Composite, that right now is lower by about 0.4% for the tech-heavy average as tech is being weighed on by AMD and Alphabet results. The S&P 500, you're seeing that down by about 0.1%. An interesting move here as well that we're seeing here. Catching a bid, you've got some small caps moving to the upside. Fractionally as it may be, the Russell 2000 is up 0.7%, and the S&P 600, which adds a profitability filter for those small cap names, that's also up by about 0.5% today. Just lastly, I'll take a look at the sector activity that we're also tracking for you. 11 sectors in the S&P 500, got them pulled up on the screen here. It looks like communication services, the biggest laggard on the day. That's down 1.6%. But real estate, that's been leading the pack throughout much of today's trading session. That's up by about 1.3%. Well, switching gears. The Philadelphia Eagles and the Kansas City Chiefs face off at the Super Bowl once again this Sunday. And our next guest helps provide all of the food and drinks for fans to dig into during the big day in stadium. Joining me now, we've got Belinda Oakley, who is the North America CEO of Sodexo Live. Belinda, great to have you here with us. Let's first talk about this experience, talk about pricing for people who are already paying thousands of dollars to get into that fan experience, into the stadium. They're also going to be thinking about some concessions along the way.
Yeah, look, Brad, it's obviously no secret that the Super Bowl is all about what's happening on the field. But for us, it's very much about what's happening in the concession stands, in the suites. We have about 4,000 team members, which we like to call our experience makers, who will bring 62,000 fans the taste of New Orleans right there. And I think, as you said, it's an event that's about football, but it's also about the food. I think the story goes it's the second largest food consumption day in the year outside of Thanksgiving for America. So we love the opportunity to bring that to life. And certainly it runs the gamut from game day favorites like hot dogs to lobster po' boys and high-end food. And just like we see in our existing spaces, the experience economy is something people are absolutely willing to pay for.
We want to take a look at the menu here because for some of us, not all of us can be there in person, but we're going to be tuning in. And here's some of the things that are going to be on the menu that fans can experience for the big game in person here. And a lot of this has kind of that taste, that flair of New Orleans as well. So kudos to you and the team for really crafting this and that consideration. I wonder on the pricing side, as it is so critical to make sure that you're offsetting all of the costs that go into bringing that experience to life, how you're also receptive of what fans are able and willing to pay, as it seems like concessions have just gotten so expensive over the years.
Yeah, look, and I think as you know, there's been a lot of economic impacts that have made it more difficult to sort of keep that fan-friendly pricing. But I think what we see today across the entire hospitality industry, and especially live events industry, is really that kind of tiered approach from a lot of focus on value favorites, whether that is the $4 hot dog to the really, really high end. You know, people are coming for this once in a lifetime experience and they want to match that with a once in a lifetime option. I think you just showed there the shrimp po' boy that we have. Obviously Super Bowl 59, we couldn't help but have a little bit of fun. We have 5 local shrimp on there and then 9-hour braised short ribs. So I would say I mentioned local, and I think that's a huge part and piece of the puzzle. The best part about bringing the taste of New Orleans to the Superdome on Sunday is that we're using a ton of local vendors. And that's really important for us generally, is putting money back into the local economy, but also bringing that quintessential New Orleans flavor to the dishes that we're serving. You know, the bread really matters. You know, what you're serving it on makes a big difference. The French roll that you get in New Orleans versus a French roll you get elsewhere. So I think that helps us a little bit on that front. And as I say, I think the big thing that we're seeing in terms of inflation and the impact on consumer pricing is that we've got to keep making those value options available in all cases so that live events are something that everyone can enjoy. But the desire for bigger, better, more exclusive, more unique, it just keeps growing and climbing.
Belinda, you know, it's an amazing kind of read-in that you get on the state of hospitality as well. through the employment lens too. And we were talking about that a little earlier in the show, just with regard to some of the economic data from ADP that published this morning on private payrolls. I wonder, through your own seat and your own perspective, what you're seeing in the dynamics of making sure that you're fully staffing not just the Super Bowl events, but also all of the other stadiums that you work in tandem partnership with to bring this concession experience to life.
Yeah, look, it's the most important piece of the puzzle, frankly. I mean, our global purchasing reach is incredible because of the size of our organization, but it doesn't really matter what you do with the food if you don't have the experience makers and talent behind it to execute. The service experience is a huge part of the overall sentiment you have when you're visiting. So for us, I think we're really, really proud that we're investing in the industry generally. So in New Orleans specifically, as an example, we have a wonderful partnership with an incredible organization called Noki, which we're using as our kind of leaping ground to hire people local from the community who might never have even thought about a career in hospitality and need a kickstart. So we offer completely free community classes to sort of get you ready for a job in the Superdome or at the Convention Center or one of the other amazing venues that we operate there. Because I think while hospitality wage prices have certainly gone up, at the end of the day, we have to keep attracting people into the hospitality industry. It is not for everyone. It's nights, it's weekends, it's hard work, but for the people who find it, they usually find they never leave. It's really for the love of the game, and it's a love of the hospitality industry that we're trying to attract.
Yeah, a lot of us had our first job in that industry as well. I certainly was one of those. Belinda, thank you so much for taking the time here with us today. Appreciate it.
Thank you. Thank you very much.
Coming up, retiring early, considering one of those government buyouts potentially? Well, we've got advice for in the unconventional retirement situations on the other side of this short break. President Trump offered millions of government workers the option to take buyouts and leave their positions, and they'll have to make a decision by tomorrow, Thursday, February 6th. And for those considering an early, forced, or otherwise unconventional retirement, we have David Strzezinski, who is the Sound Planning Group CEO, here with some advice. David, good to have you on the program with us. You have 7 steps all people should consider before retirement. So do these change at all if you're retiring early?
Well, there's 7 steps or 7 key areas financially that we need to be prepared It doesn't matter what your age, what your retirement needs are. And so those steps are, number one, we need to plan for income, because if you fail to plan, you plan to fail. One of the big issues right now is that if your outgo exceeds your income, your upkeep's going to be your downfall. So we got to know what that burn rate is. And that a real key to that is also what you're going to do with your Social Security. So as an investment strategy, that's number two. And so the strategies of today are very important. Now, a lot of people are looking at their 401k. Do you know you can roll that over to an individual retirement account, get perhaps better ideas on that? And so that's a really important idea. But let's not forget about tax diversification in the midst of strategy diversification. The big opportunity right now, Tax Cuts and Jobs Act 2.0 is here. And ultimately, tax diversification is key. Roth IRAs, there's 101 different ways of doing this. We got healthcare planning, critical to do, get your Medicare right, your healthcare right. Big changes actually happen here in 2025 with that. And then we move into our step 5, which is real estate. We need to have a plan for real estate. We need to have an understanding for our primary residence, Section 121 deductions. We could sell and offset $250,000 per person as capital gains. That's a really great idea for a lot of people that are entering into retirement. And then estate planning. You got to get your legal components of this right. And then, of course, our ongoing review and evaluation process is critical. So I don't know what people are doing in all 7 of those categories, but I can tell you this much. Every single person that's looking at retirement has 3 things in mind. They want confidence in what they're doing, clarity to know what it is, and ultimately more control. And so we give that 7-step process, and that's our way of sharing it.
For anyone considering leaving the workforce in their 50s, or hey, and if you can, more power to you, or early 60s, what should they be considering?
Okay, well, there's a number of things that are very important, especially if you retire earlier than like age 65. Why? Medicare or your health care becomes very expensive to pay for on your own. And so, maybe you want to start a side hustle or something like that. There's a lot of ways to figure this out. But yes, we need to make a spending plan, which is so important. If your outgo exceeds your income, your upkeep will be your downfall. You got to also take control of your investments. And so, the portfolio that you would have in your 50s is potentially very different than the portfolio you'd have in your 70s. But if you're entering into retirement, actually they have more in common than you might think, because the goal here is that we ultimately need to create an income plan that is going to give us the most tax efficient withdrawal strategy. And so that is the key as people are looking before they leave.
What about individuals who want to save aggressively and potentially even retire in their 30s?
Yeah, well, this is a moving trend. And so a couple things that I would say to that group is, what are you going to refire to? And so if your why is big enough, you will sacrifice and live like nobody else today. That means saving more, spending less, not trying to keep up with the Joneses in order to put yourself in that position in the future. But you want to ultimately ask yourself, what are you trying to do? And what are you trying to accomplish? If you're trying to take money out of a 401k or an IRA and you're under the age of 59 and a half, that could be challenging unless you understand some of the rules. And so you just need to get this right. You got to set these things into motion at an early place, but you need to understand the diversification and ultimately the required rate of return that's going to take you in order to achieve that lifestyle that you're looking for and to ultimately accomplish those goals. So that high net worth person has a really exciting road in front of them, but they got some planning.
And finally, for wealthy individuals who don't need an annual salary, do you recommend retirement?
Well, there's a lot of people today, professionals, maybe in healthcare, usually key stakeholders that we see are working beyond maybe age 65 or something into their 70s. They have something to give back, so I think that people should do what makes them happy. If you have something to give back, like my father is an example, 71 years old, he's still giving back. My mom, 71 years old, still giving back. They could retire, but they choose to stay in the game because they get value from it. One thing I'll just note is that potentially for men, it's a little bit more challenging to make that transition from, hey, everyone says hi to you and looks up to you in the office, and then if you say you're not doing that role anymore and you just go home, maybe your wife doesn't respond the same way, kids don't respond the same way at home, and it feels a little different. So it could be a real culture shock as you go from the work life to that retirement. Every day's a Saturday, and this is my new people every day. And so I just think people should look before they leap. There's great books out there, great ways to prepare. But these 7 steps will help people as well.
David, thanks for taking the time here with us with the retirement tips. Appreciate it.
Pleasure's mine, Brad. Thank you.
Elon Musk sparked surprise yesterday on X when he posted that the team behind the IRS's free direct file program has been, quote, deleted. You still have over 2 months before the April 15th tax filing deadline. And depending upon your tax situation, it can be completed and complicated and even costly to file your taxes each year. Here to break down why, we've got Yahoo Finance's very own Jana Heron. Jana, what's going on here? Can you break this down for us?
Sure, Brad. Maybe a good way to illustrate how complex our tax system is by comparing us to other people in other countries. So one guy from Sweden I talked to gets a pre-populated tax return, and he can accept that return by mail, app, calling a phone number, or even texting. Another guy in the UK doesn't have to file a tax return on the income from his employer because his paycheck tax withholdings are so precise. Obviously, that is not how it is here, and there's a couple reasons for that. So one of those big reasons is our withholdings from our paycheck are not as precise as they could be. And that is because we have the married filing jointly status. In other countries, everyone is an individual status. And so, if you have a married couple, both the wife and the husband have their own taxes. We have a joint unit, so it makes it really harder to get those withholdings correct. We also legislate a lot of social policy through our tax system. So we get all of these tax deductions and credits that in other countries may not have because they have actual social programs for it. Healthcare is a good example. We have credits and deductions, whereas other countries have a universal healthcare system. And then we have all those lobbying groups that love those certain credits and deductions. The housing industry loves the mortgage interest deduction, so they work hard and spend a lot of money to keep it in our tax code. And of course, the tax prep companies love the complexity of the system because we need to turn to them to do our taxes.
So, Janet, can the U.S. tax process be simplified?
Oh, yes, it can. But it's slow going. And there's been, a lot of proposals over the years to do that. But let me tell you about two things. The Tax Cuts and Jobs Act in 2017 under the first Trump administration. So that doubled the standard deduction and it curbed several itemized deductions. And that dramatically reduced the number of taxpayers who would choose to itemize their taxes. And not itemizing actually is simplifying taxes for those people. And then we also have, as you mentioned earlier, the IRS has the direct file program, which debuted last year and lets you submit a return straight to Uncle Sam at no cost. And now it's actually expanded, and it can automatically import some of your W-2 information directly from the IRS and it process more returns that have some, different claims and tax credits than the ones from last year. But it's still like a far cry from what other countries do, which is, you get a pre-populated tax return. And the simplest process out there would be to have the IRS calculate exactly how much we owe or how much we are owed. And to do that, we require some legislative changes. So we're far away from that.
Jana, thanks so much for taking the time here with us today.
Great, thanks.
Certainly. Before we go to break, this Black History Month, we celebrate the power brokers in business, the executives, entrepreneurs, proven change makers who have advanced economy and society. And in addition to individuals that we're highlighting, it also takes companies unwavering from their efforts for diversity, inclusion, and equity. DEI, or diversity, equity, and inclusion initiatives, they seek to correct some of the long-standing discrimination experienced by people of color and LGBTQ+ workers in the workplace. That discrimination, according to Citigroup, cost the U.S. economy $16 trillion between 2000 and 2020. Despite a quantifiable economic impact stemming from racism and discrimination, early in Trump's return to the White House, he sought to reverse initiatives such as racial bias training at work, diversity, equity, and inclusion offices and programs, and a 1965 executive order establishing non-discriminatory hiring practices for federal contractors. However, some businesses are publicly standing by their own diversity initiatives and values. When discussing the matter with Yahoo Finance at the World Economic Forum, Nasdaq CEO Adena Friedman had this to say.
I can say for Nasdaq,
we're very proud of what we do. We're very comfortable and confident in what we do. We feel very good about the results that we've been able to achieve in terms of creating that culture of inclusivity and belonging. And I think a lot of companies feel the same way I do. And it's just going to be a little bit quieter in how they implement.
JP Morgan CEO Jamie Dimon also reaffirmed his commitment to diversity and inclusion at Davos in the face of shareholder activist attempts to disband programs. And it's not only executives who are pushing back here. Costco shareholders, they voted to block an anti-DEI proposal from a conservative firm, the National Center for Public Policy Research. 98% of shareholders who voted chose to defend existing diversity policies. Coming up, could a potential investigation in China be bad news for fans of smaller iPhones? We have your weekly tech support segment next. A programming note on a new episode of Trader Talk. Slate Stone Wealth's chief market strategist, Kenny Polcari, sits down with John Lonsky, who's the founder of the Lonsky Group and former chief economist at Moody's, to explore how rate increases, tariffs, and consumer spending are being affected by the new administration.
My fear is, could we see inflation get even worse than it was the first time? Meaning it was at 9% at the height of the Biden years. Could we see it get worse?
Okay, I'm going to go out on a limb and say no. I don't think that's going to be the case, but you're going to replay this in the future and say, Lonsky said it wouldn't hit 9%, it went to 10 or 11%.
Yeah.
But please don't do that.
No.
I think we have a different economy today. One thing, a big difference between today and what held true in the late 70s and the early 80s is we have a much older economy.
Right.
And I think that limits the upside for consumer spending growth. I think that limits the upside for pricing power among businesses. I think, and you're seeing this aging of the U.S. economy. It's reflected in a lot of these consumer spending numbers that nobody's mentioning.
Right.
I was shocked to notice that healthcare spending in the third quarter was up 9% year over year. The rest of consumer spending less than 5%. And that's indicative. Right. We're getting older.
You can watch Trader Talk with Kenny Polcari every Wednesday, 12 p.m. on Yahoo Finance or wherever you get your podcasts. It's time now for Tech Support, our weekly segment about all things technology. This week, taking a look at the latest news from Apple, starting with the reports that it could be facing an investigation in China. Dan Halley, Yahoo Finance's tech editor, joins me now. Dan, is there any chance this probe or the escalating trade tensions between China and the U.S. could jeopardize the launch of the iPhone SE 4?
Well, the thing here that is important to note is that this is looking at Apple's
App Store sales. So this isn't exactly something that is unheard of around the world. They already faced a probe, obviously, in the EU. They've gone through this whole process. They have to open up to third-party app stores. They've been accused of unfair practices here in the U.S. as well by companies, with the 30% kind of tax that they levy on app developers that sell through the App Store. And so it's not as though this is out of the blue, but the fact that it does come as tariffs are being put into place by the U.S. on Chinese goods means that Apple is now part of the tit-for-tat war. And so, this comes as Google is also being probed. So, that's the App Store portion of it. As far as the iPhone SE, that's expected to launch sometime this spring, according to Mark Gurman at Bloomberg. And so that phone is going to be reportedly a low-cost option for iPhone users to get in and start using Apple Intelligence. Now, as far as China's concerned, Apple doesn't even have Apple Intelligence in China yet because they don't have a proper partner. They can't use ChatGPT in China as they do in the US. And so it would be more about the phone itself. Now, do I think that that's going to hurt phone sales? Not particularly. I think it's actually going to help them, not the ban, but the fact that it's a low-cost phone. Yeah. So it could do well for Apple over there.
Dan, appreciate the tech support today. Thanks. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down 2 and 3, the market close.
It's time for Yahoo Finance's Market Minute. Stock shrugging off earlier losses. Now digging into some of today's movers. We have Supermicro Computer jumping after announcing full production of its AI data centers powered by NVIDIA's Blackwell chips. The company's offerings include cooling systems with multiple CPU options. Novo Nordisk shares are gaining after beating earnings estimates. Sales of its weight loss and diabetes drugs, they surged. The CEO telling Yahoo Finance that he expects, quote, the same absolute growth for 2025. And Snap reversing earlier gains. You have shares falling after the company issued a disappointing earnings outlook, overshadowing its revenue beat. And that is your Yahoo Finance Market Minute. For more on what is trending on Yahoo Finance, you can scan the QR code below to track the best and worst performing stocks of the session.